Hello everybody. How are you all? Hello all my bankers. This is Radhika Dua and I will be your mentor today for this amazing session of yours where we will be completing all the numericals. All 3 units, we are going to cover the numerical portion, module A, module B, module C. All the modules numerical portion will be covered, but we will start with module C first, then we'll move ahead. Just give me 1 second so that I can add the class people as well. Just 1 second. Yes. So we are live on the app as well. Okay. So yes, we can start. As said before, this is Radhika Dua and I will be with you throughout. Till the time we do not complete our numericals, I am not going anywhere and I'm not letting anybody else go away. So we will be continuing. We will be doing all the questions that are required for the exam. All 3 modules. All the modules, we are doing the numerical portion. Okay, so let's start. As said before, I'll be doing module C first, then we'll move accordingly. Okay, I'll just open the panel for all. Let's wait for another 2 minutes so that everybody can join and we will go about it then. Another thing I want from you all is a promise that you are going to interact in the session. Wherever you feel something is not clear or you need some explanation, do let me know. Also, do let me know if you know the answer already, A, B, C, D, whichever option is the correct option, you write it in the chat box. I am here throughout. I'll be reading the chat and I'll be corresponding with you. Okay then. Yes, we'll start at 8:05 exact. Let others join. Important numerical portion, all the numerical questions will be started soon. So till then, why don't you all tell me that you are joining us from which state? So I will take you to module C first, then we'll move to the other volumes. Since we did module C together, let's do the questions first for module C, then we'll move to other modules. Okay. Okay. So we are starting now. So it's 8:05 and we are starting the session. As promised, others can join. You can, ping your friends and they can all join us later. And let's start then. Question number 1 on your computer screens. Module C, unit 13, that is the first module for this, first unit for this module, where we studied how and what are the various values implying enterprise value, FCFFs, FCFEs, how, what are the various ways of determining the value of the enterprise assets, intangible, whatever we could, we covered in this unit. Intangibles were covered in the next unit. So all the tangibles were covered here. So let's do the questions then, the numerical portion. Also, if you want revision of any unit for module C, you can just let me know. I'll give you a quick revision and then we can do the questions. Okay. Question number 1 on your computer screens then. A company's balance sheet for financial year 24-25 shows the following book values. All my focus is what is given, book values. Okay. Equity share capital 40, reserve surplus 110. Matlab equity shareholders fund is how much? Shareholder fund is how much? 40 plus 110, that is 150. Long-term debt 70, fixed assets book value, net book value, that is fixed assets minus depreciation 130, investments book value 20, net working capital book value is this much. Working capital is CA minus CL, that is your working capital, right? Okay. During a valuation exercise in January 2025, the valuer determines the following fair value adjustments. Okay, what are the adjustments? The fixed assets have appreciated by 18% of their book value. So the fixed assets are going to be appreciated by 18%. Okay. One investment which has book value of 6 has become worthless. Basically, book value is 6, but market value is worthless, meaning it's 0. So it will be minus 6 CR, right? It's negative 6 CR. Okay. In my book value, I have 6 CR, but in reality, it has become 0. It has become 0. So, sorry, in reality, it has become 0. So, the net change is of negative 6. The net change is of negative 6, right? Fair value minus book value, right? So, fair value is 0. Book value is 6. So, the net effect is minus 6. Okay. Another investment, book value 12 CR has a fair value 25% higher than the book value. That is plus 25%. Plus 25%. So, this for investments, one adjustment will be minus 6. Another adjustment will be plus 25% of 12. Right? There is an unrecorded environmental liability. Unrecorded liability, implying the liability was lesser and I have to increase it now. I have to increase the estimation by 9 CR. I have to increase my liabilities. 40% of inventory, part of current assets here, worth 30 CR is obsolete and realizable at only 30% of its book value, implying there is a negative impact. I have already accounted it at 100% capacity. I will have to reduce it to 30% capacity, implying there will be a negative 70% capacity. So negative 70% will be there, the net impact, right? A receivable of 5 CR is doubtful and recoverable only at 20%, implying again negative 80%. What is the adjusted book value, ABV, of the equity? First of all, understand what is adjusted book value. Your book value plus minus whatever the adjustments are. Plus minus the book value, that is the shareholder fund, that is your book value, right? Your shareholder fund is your book value plus minus all the adjustments that are given. That if there is an increase, you will have a positive impact. If there is a decrease in the assets, it will have a negative impact. If there is an increase in liabilities, it will be a negative impact, right? So we will make adjustments accordingly. Any doubt till here? Is the question clear to you all? Please let me know, is the question clear to everybody? If not, then I can repeat it. Just waiting for everybody to reply. Okay, then let's do the adjustments, right? You will get questions like this in the exam because these are very quick to do questions. The question is lengthy, but the answer will be very quick because till the time we were reading, we were actually calculating plus minus impact, and that is why it is quick to solve. So let's have the solution. So the adjusted book value will be your book value plus minus your fair value adjustments, right? So book value will be how much? The book value is always equals to your reserves and surplus plus your share capital. So share capital plus reserve surplus, that is 40 plus 110, which is 150. And in this 150, I will take plus minus impact of fair value. So first adjustment is that the fixed asset has increased by 18%. There is an appreciation of 18%. So 130 into 18%, that is plus 23.40. One of the investments have become worthless, implying the fair value is 0 and the book value is 6. So then there will be negative impact of minus 6. Another adjustment is one of the inventory of 12 of this, one of the inventories, one of the investment which has book value of 12 CR has a fair value higher, implying that this 12 CR is 100%. I have to value it now at 125%. That is why multiplying it by 1.25 minus the book value. So the point plus 3. Otherwise, what I could have done is 12 into 12 into 25%. That would have also given you the same answer. 12 into 25%. Same answer, right? Then the net increase will be minus 6 plus 3, that is minus 3. So one impact I have is this. One impact I have is this, and the other impact I have is minus 3. Next, the third impact that I have to take into picture is there is unrecorded liability of 9 CR. So yes, let's record minus 9 CR. Liability has increased, so outflow of cash, so minus 9. 40% of inventory worth 30 CR is obsolete, that is negative 30. The impact will be minus 30. Obsolete portion, sorry, 40% of this 40% of inventory part worth 30 crore. 40% of inventory part of current assets, that is worth 30 CR. So 30 CR's 40% is how much? 30 CR's 40% is 12 CR, and that has become worthless, and only 30% of it is realizable, implying 30 CR is my current asset, out of which 40% has become obsolete, that is 12. Out of this 12, only 30% is realizable. So 30% of 12 is 3.60. So what is the net impact? What is the net impact? 3.60 is realizable, and 12 was the fair book value. So it is negative 8.4. Now for current assets, the adjustment says a receivable of 5 CR is doubtful and recoverable only at 20%. So 5 CR ka 20%, that is 1. Only 1 CR is recoverable. So minus 4. So net impact will be minus 8, minus 4, minus 12.4. And so plus 23, minus 3, minus 9, minus 12.4, which will give you minus of 1. The net impact will be minus 1. The net impact will be negative 1. So 150 negative 1, which will give you 149 CR. This is the adjusted book value. This is the adjusted book value. So answer number, option number D is correct. Option number D is the correct answer. Were you able to solve this, everybody? Were you able to solve the question? You will get, what you have to do is you have to find out the net impacts, which is very easy. You can calculate it within 2 minutes. So yes, you will get questions like such. So Philemon sir has a doubt. Yes sir, please. Very good, Rajendra Prasad sir. Very good. Answer absolutely correct. Okay. Next question. Next question that I have for you is question number 2. You will get such questions in exam, so please make sure that you know how the calculations are being done here. Question number 2. A bank is assessing its short-term liquidity profile using stock and debt approach. What was in stock and debt approach? Give me a quick recap. Stock and debt approach took stock and the debt portion only. The following information is available: cash and balance with RBI, fully liquid; marketable government securities, 100% liquidity value; corporate bonds, only 50% of them are liquid; interbank borrowings, it is an outflow; retail deposits, expected withdrawal, it's also an outflow; committed credit lines to customers, 60% drawdown expected. Okay. So that is only 60%. Drawdown lines from other banks, 40% reliability, only 40% will be taken from here and only 60% can be taken out of 1400. Wholesale borrowings availability is 100,000, 1000 and only 20% is reliable under stress. Bills rediscounting facility, only 70% is reliable. Using the stock and debt approach, compute the liquidity or surplus deficit for the next 30 days. You have to use the stock and debt approach. Very important. Good question and very easy to solve. Let's solve it together. So, what I have to do is, first of all, I'll calculate how much liquid assets I have, the total liquid assets. Let's do that. I already have the values 2500, 4800, 1200, 3000, 2500, 4800, 1200. Assets, that is this one, 1400, 1800, 1800. Just only for committed credit lines to customers, this was an outflow, right? This was a outflow and only 60% drawdown expected. Okay, so wholesale borrowing available 1600. 1600. So 1600, 1800, 2500, 4800 and 1200. This is what is available to me right now. 2500, 4800, 1200, 18, 1000 and 600. I have to see how much liquidity I have. For cash, 100%, corporate 100%, and this is given in the question. So I calculated the liquid value. Very, very simple. You will not have to make the chart in the exam. All you have to do is do the calculations over the calculator, which we have already done in our classes. That how do you calculate over, how do you mark everything in the memory, then you calculate everything. We have already done that, right? So the total liquid stock will be 9240 CR. Okay. Now what is the expected debt outflow? How much you have to, what will be the outflow, right? So first will be interbank borrowings, which are maturing soon. 3000, 100% you have to pay back, so 3000. Retail deposit withdrawals, 2200, 100%, which is 2200. For committed credit lines, 1400, and the drawdown is 60%, right? Yes, the drawdown is 60%. So the total outflow will be 6040. So how much do I have to pay right now? It will be 9240 minus 6040, which is 3200 surplus you have right now. So the correct answer will be okay, 3200 you have the I'll change the option. It is 3200, not 00. So the correct answer will be B. Correct answer will be B. B is the correct option. Were you able to solve this? It was a good question and an easy question. Were you able to solve this, everybody? It's a good question. All you had to do was check your this thing. surplus or deficit, how much stock debt approach, how much you have to give right now, and how much you have to, if you will receive right now, how much you will receive right now. So whether you are in surplus or you are in deficit. Great, great, very good. Moving ahead, next question that we have for you, question number 3. It was a good question and this might come in exam. Next question. Question number 3. A valuer is estimating the market value of residential property in Feb using the direct comparison approach. For direct comparison approach, similar asset in the market which was sold recently. Details of the subject property is this. You need to, okay, so let me increase the size of this so that it is visible to everybody. Okay, the sales price for company A is this much, company B is this much, company C is this much. Similar asset, floor also they have given, building age they have given, corner units they have given, and sale month they have given, right? Market derived adjusted factors are time adjustment is plus 6% per month forward to February. Area adjustment is rupees 1200 per square feet difference. Floor adjustment is plus 0.75% per floor difference. Age adjustment is minus 0.40% per year difference. And corner unit premium is plus 3%. So all I have to do, I'll find similar asset in the for different companies, and I'll adjust with the variables that there are. I'll take adjustments for that, right? Right now, I want to sell my residential property which has carpet area of 1280 square feet. Company A sold similar asset with area of 1350 square feet at 144,000,000, that is 1 crore 44 lakh rupees, right? What the question says, for every area, 1200 rupees per square feet difference. So their square feet was 1350. My square feet is 1280. So what is the difference? 30 square feet difference I have right now. Sorry, 70 square feet difference I have right now. 70 into 1200 per square feet. So 70 into 1200. This is how much there should be a difference. This is how much there should be a difference. Same ways for every aspect and every company I can do it. So let's do it together. Let's do it together. You got the question? What's there in the question, right? So let's solve the question together. Understood the question? Exactly what's happening in the question, right? Okay. हम क्या करेंगे? For time adjustment, एक एक उठाते हैं and let's start doing it. For first we have is time adjustment. 0.6% per month forward to February. You have to take a positive impact of it. Plus करना है 0.6%. For company A, April में बिका था, so May, June, July, August, September, October, November, December, January, February. 10 months. May, June, July, August, September, October, November, December, January, February. I have to take impact of 10 months. ठीक है, तो कर लेते हैं 10 months के लिए. सबसे पहले time adjustment from August to February. Okay, I am taking for my nearest company. So nearest B is nearest to me, right? B is nearest to me. Achha, the question only says using component B only. Compute the adjusted price of the 6 into 6, that is 3.6% adjustment has to be taken. So price will be adjusted as, it was sold for 1 crore 26 lakh rupees. So ours will be 1 crore 26 plus 3.6%. right? So it will be 1 crore 26,000 or 1 crore 26 lakhs into 1.036, which is 130,536,000. One thing done. Next, area adjustment, 1200 per square feet. So let's rub this off. Let's take it for company B only. Ours is 1280, theirs is 1200. So that is 80 square feet we are excess. So 80 into 1200. This is how much we should get more. So plus 80 square feet, 96,000 should be added. So the new price will be 130,53,600 plus 96,000. Next adjustment will be floor adjustment, that is positive 0.75% for floor difference. Okay, we are on second floor, they were on first floor. So there will be again an increase for 0.75%. There is an increase of one floor, so 0.75% will be increased. So it will be 0.75% of 131,4986,600. There will be an increase of 98,600. So the new price is 132,48,200. Last, okay, next adjustment is age adjustment, that is minus 0.40%. Make sense, जितनी पुरानी बिल्डिंग होगी उतना सस्ता बिकेगा, है ना? तो हमको क्या करना है, हमको उसकी एडजस्टमेंट लेनी पड़ेगी. जो कंपनी बी ने बिल्डिंग बेची है वो 10 साल पुरानी थी और जो हम बेच रहे हैं वो 8 साल पुरानी है सिर्फ, तो हमारे लिए तो पॉजिटिव है, देयर इज अ पॉजिटिव चेंज. So for us, there is a difference of 2 years. So minus 0.40 into 2, so minus 0.8% should be taken into account. So the new price minus 0.80, which will be 13142. 13142. And there is a premium of 3% for corner. And did we have corner with us? Yes, there was a corner unit, yes, and they also had corner unit, yes. So there will be no premium since both of us had corner. We both of us were having corner unit, so no premium will be added, no adjustment for that. So the total new price is 13142,214, which is option number A. Which is option number A. Is this clear? Making sense to you all? Is this clear? Making sense to you all? Everybody, please let me know. Or do you have any sort of doubt, you can ask. अगर आपको किसी भी तरीके का डाउट है आप पूछ सकते हैं. What did I do? I took the adjustment for any difference which was between me and a similar asset sold in the market, and the adjustment was given, and again we could solve it in within 2 minutes. So it is easy question and can be asked in exam, because these questions are the questions, believe me you when I'm telling you, these questions are worth doing right now, because your exam is just around there, right? So these are good questions which will come in the exam. Next, this was a very good question. Next question that we have is question number 4. A company is evaluating a project expected to generate the following free cash flow. FCFs are given to us. First year 48, 56, 62, 70, and the fifth year is the terminal year. Okay. For terminal year, that the expected flow either will grow at the stagnant rate or it will stop here. So the additional information given to us is the project's weighted average cost of capital is 11.5%. Long-term stable growth after 4 years is 4.2%. That is 70 plus 4.2%. This will go on forever. The stable growth rate is 4.2%. So if I calculate the terminal value, I can very easily calculate today's present value. Just to give you a summary how these type of questions work. So I am standing at 0 point. I have estimated that my company will earn this much in the coming years. Now this is the terminal value, implying that after this there will be stable growth. So what I want to do is I want to calculate the present value of each cash flow, and I want to calculate the terminal value first First step is calculate the terminal value and then calculate the present value of this terminal value as well. This is my whole goal. ऐसे निकालते हैं हम, right? So let's see how we are going to do this. Moving ahead, expected FCF in year 5 grows at the above rate from year 4 FCF. Okay, that we already knew that this growth will take place from year 4. Initial investment required today is 210 lakh rupees. If the present value, the sum of all the present value is more than the outflow, if the present value of this is more than the outflow today, 0 period outflow is how much? 210 lakh rupees. If the present value, the inflow value is more than outflow value, then I should invest, otherwise I should not invest, right? Ignore taxes and inflation, find the project's NPV using DCF approach. This is the DCF approach, you discount the cash flows given to you. So that is how we'll do. So let's do it together. Okay, for finding the terminal value, the most important thing is find the terminal value and then discount it. Find the second step should be find the present value of this terminal value. Okay, let's do it then. So compute the year 5 FCF. Growth is 4%. So the FCF for the 5th year will be 70 into 1 plus 0.042, right? 70 into 1 plus 0.042. How did I get 042? 4.2% into decimals. That is what I have done for the ease of it, right? Which will come to 42.94. You can do it in your on your calculators. What I have done is 1.042 into 70, which is 72.94. Got it? Next, you find the next step number 1. I have done step number 1. Now I have to find the present value of this terminal value. Okay. So what do I do is, how do I find the terminal value of a amount which is after 5 years? 1, 2, 3, 4, 5. So how do I find the present value of this amount which came to 72.94? I need to discount it and find the present value today. So I'll have to divide it by power 5. 1 year, 2 year, 3 year, 4 year, 5 year. So the terminal value using Gordon growth model, I can very easily find it, which is 72.94 divided by WACC minus, since WACC was given to me 11.6%, I can very easily find it. So it will be 72.94 divided by KE minus G. KE is how much with me? KE is 11.5 minus G. G is 0.042, right? So which will come to 11.5 minus 0.042. Oh, sorry, which not 0.042, it is 4.2 minus 4.2, which will come to 11 minus 4.2, 6.8. Oh, sorry, 0.073. Okay. So what you are going to do is 0.115 minus 0.042. 0.073, correct. 0.113 minus 0.042. What you can do is either take both of them without decimals or take both of them in decimals. Either take both of them in percentages or take both of them in decimals. So I took both of them in decimals. So 72.94 divided by 0.073, which will come to 99.18, right? So let's calculate that then. Discount the factors. You can discount them, which will be 48, 56, 62, 70 and 999.10, and then we can discount them. And the answer will come to 824.66. So 824.66 plus 999. Sorry, so it is 824.66 minus your outflow today. So this is the NPV. This is the NPV. Any doubts? Any doubts, anybody? How did I calculate the present value using the terminal value? That also I can show you that how did we do it. All you need to do is calculate the terminal value, right? So the terminal value will be 70. See, I know that my P0 is equals to D1 divided by KE minus G. This is the formula that we know. We know D1 is how much? The terminal value of the 5th year, FCFF of the 5th year, minus KE is WAC, since WACC is given to us, minus G. This will be your P0. This will be your terminal value. So the only formula you need to remember is your one formula, dividend discount model. PO is equals to D1 upon KE minus G. That is how you can calculate your, okay, this is the 5th value was 72.94. I need to calculate the terminal value. This was for the 5th year. I need to calculate the terminal value, which will be divided by KE minus G, and I got my terminal value. Now the terminal value came to 999.18. That is 999.18. I needed to calculate the present value, and I can do it. Very simple. Very simple. For discounting factors, in fact, what you should do is, for 11.5%, what you should do is 1 divided by 1.115, which will be 0.896, 0.80, 0.721. So yes, that is how you can use the calculator and calculate your discounting values. So it is as simple as that. Any doubt, anybody till here? Any doubt, anybody? It was an important question. Again, very simple yet important question. But lengthy question, yes. Yes, that also you could have given if they had given only first year value. Very good question, Rajendra sir. If they had given only first year value and they have told that after the first year the growth is for 9%, second year growth is for 13%, next year growth is for 15%, and so on, and after fourth year the growth will be stable at 4.2%. We could have taken out for every year, we could have taken out our inflows, right? Very good question, but I don't think that will be asked in exams, since already there's a lot of calculation which is involved in this question. So I don't think that much more calculations will be asked from you. This is already a lengthy question. Let's do it once again. For the ease of everybody, I'll do it once again. Okay, so what did we do? This is a good question. These calculations will be required in all DCF models. Two-way, two-level, two-division DCF is also solved like this. So let me do it again for you. It will take only 2 minutes, but since it is important, I want to spend time over this. So what has happened here is, I'm standing at 0 point, and I know I have various inflows. First year inflow is 48, second year inflow is 56, third year inflow is 62, after that it's 70, and then fifth year is terminal value 1, 2, 3, 4, 5. I need to find out, today the initial investment is of 210 CR, 210 lakh rupees. I want to find out whether I should invest in this project or not. That is, find the NPV. If I have to find the NPV, which is outflow minus your inflow, it will give me my NPV. If the NPV is positive, I invest in this. If the NPV is negative, I don't invest in this, right? So what I can do is I can simply find out the present value of the inflows in the coming years, right? But I don't know what my terminal value is. So first I have to, step number 1 is to find out my terminal value. Then step number 2 will be to find out my present value of all these inflows, sum of my inflows, right? To find out the terminal value, I have one simple formula. Throughout module C, I told you not to learn anything, just one formula, that is price today will be equal to dividend in the coming, inflow in the coming year divided by your interest rate minus your growth. If interest rate is not, inflow in the coming year is not given to you, what do? D0 into 1 plus G, right? If D1 is not given to you, what do? D0 1 plus G. So can I find out the inflow in the 5th year? Yes, I can find out the inflow in the 5th year, which will be 70 into 1 plus 0.042. 70 into 1 plus 0.042, which will come to 72.94, which will come to 72.94. So I calculated my D1. My D1 came out as 72.94. Substituting the values here, I got my terminal value as 999.18. Right? I substituted the values in this formula because since I didn't have D1, I calculated it using D0 into 1 plus G. That is 70 into 1 plus 0.042. I calculated my terminal value. All I have to do is, I have different values with me. All I have to do is, I have to calculate my present value. So how do I do that? I have my discounting factor, that is 11.5. I have my discounting factor, that is 11.5. Wait, I'll just make it bigger for you all so that you know it is more visible to everybody. So all I need to do is calculate my discounting factors. That also I have told you how to use the calculator in the class. All you have to do is 1 divided by 1 plus the discounting factor. So 1 divided by 1.115. 11.5 in decimals will be 0.115. So 1 divided by 1 plus the discounting factor. So 1 divided by 1.115. You press the equals to. You get the discounting factor for first year. You again press equals to. It will give you second year's discounting factor. Again press equals to. You get third year, fourth year, fifth year. Fourth year. Actually, we need only for 4 years. So you see the terminal value and the fourth year value, the same factor will be used. Why? Because I calculated the terminal value. I calculated the price here. PO is for this P4. I calculated P4, right? In this given question, I calculated P4 using discount factor 5. Right? So I calculated P4. The terminal value that I calculated was here, to be precise. And then I calculated my present value. Right? Making sense, right? So yes, that is why this is important for exam. That fourth year and terminal value discounting factor will be same. All you have to do is, for making the calculation simple, what I'm going to help you is, you write the discounting factors. 48 into 0.896861. You press equals to, and then you put it into memory. Same way, every calculation you put it into the memory, and at last you press MRC. Which will give you the sum total of all the memory items, the sum total of all the memory items, which will come to 824. And my inflow was today, my outflow was today 210. Inflow is 824. So yes, it is a profitable project. The NPV will be 668 and I should invest in it. So the correct answer is 668, which is answer number A, nearest answer, 668 lakh rupees. Okay, moving ahead. 614.668. So yes, option number A is the correct answer. Any doubt, anybody? If anybody has any sort of doubt, you can ask me. It's a good question. Okay, next question, question number 5. A manufacturing company for financial year 24-25 reports the following data. Revenue from operations is this much. Operating expenses excluding depreciation. So I have not taken into account my depreciation. So if I calculate my earnings before interest, taxes and depreciation, so I'm calculating my IPTA, right? It will be 3250 minus 2120. Depreciation is given as 240. Non-operating income is 65. Interest expense is 95. Then I'll have to subtract my interest expense. One time operating reconstruction expenses 60. Corporate taxes 31%. Additional information for NOPLAT, very important. I've already given you how you calculate your NOPLAT. Reconstruction cost is considered as non-recurring, so it should be added back to arrive at the adjusted operating profit. Even if this line was not given, I would have added it back since it is one time. Non-operating income must be excluded from EBIT. Yes, makes sense. Interest cost is ignored for EBIT and NOPLAT. We know that. What is the NOPLAT for financial year 25-26? Easiest question that you could have got is this. You could have gotten the easiest question. This is the easiest question that there can be, right? And free number for you. So let's calculate it together. First, I calculate my operating profit before depreciation, which will be, of course, revenue minus your operating expenses excluding depreciation, which is 3250 minus 2120, which comes to 31130, right? Which comes to 1130. Okay. Now I subtract my depreciation from it and I get my EBIT. If I calculate, I subtract depreciation from it, then I'll have my EBIT, right? So earnings before interest, taxes, depreciation, amortization. That is why I told you IPTA is given to us, 3250. Okay. Then I calculated without adjustments, it is 1130 minus your debt. EBIT will be given to me. Then remove your non-operating income. What is the non-operating income? Non-operating income from treasury investment is 65. So I'll have to remove it. I removed my non-treasury income and I will have to add back my one-time expense. One-time expense should be added back. Since this is not correct expense, this will not show me the correct picture, I'll add it back. It is not related to my operations. It is not it is not there for my business. It is just one-time expense. So I will get rid of it. So that is why I'm adding it back. That is why I'm adding it back. So adjusted EBIT will be 885, right? Making sense, right? Why did I remove my non-operating income? Since it is not a part of my true earnings. So I got rid of that as well. So I compute taxes on my EBIT, which will be 885 into 31%. For my NOPLAT, it will be EBIT adjusted minus your taxes. So adjusted EBIT minus your taxes, which will come to 610.65. 610.65. B is the correct answer. B is the correct answer, everybody. So this was the easiest. If you get such questions, it will be very good for you, right? Any doubt, anybody here? Do let me know. This was a very good question. Okay, next. A company reports the following financials for 24-25. EBIT is this much, corporate tax is this much, operating current assets is this much, operating current liability is this much. I have my working capital. Net PPE, that is my asset. Operating leases, I have got my present value. This is because these are all my assets. Cash and cash equivalent, asset. Long-term investments, but non-operating, this much. Interest expenses already excluded from EBIT. Interest expense is already included. So this is not true EBIT. I'll have to add it back. Right? No goodwill is included in assets. Only operating assets and liability should be used for invested capital. Okay. Calculate ROIC. Calculate ROIC. That is return on invested capital. Let's do it together. So I calculate my NOPLAT. Simple. I have my 1280 as my interest expense. I calculated after taxes. So EBIT after taxes will be minus 0.28% into 72%. Why into 0.72%? Why 0.72? Because interest was already included. Interest was already included. That is why. Right. So it will come to 921.6. Okay. Now, sorry, here 0.72 is 1 minus 0.28. Interest was already excluded. So that is why we have not taken account of this. Going ahead, I have to compute my operating invested capital. How do I do that? Simple. I have my operating assets. I have my operating liabilities. I get my net operating working capital. That is 1230. Operating long-term assets I have. I cannot include my cash and non-operating investments since we do not include our cash for immediate payment, because I want to understand how much I have to. If today right now I pay all my expenses and I get all my receivables, all my assets, then except for cash, how much more money I need. That is why no cash, right? No cash will be taken into account, and of course this will all long-term investments will never be taken into account if they are non-operating. Since they are non-operating, both of this will never be taken into account. So we are not taking that. So operating LT assets will be how much? 3400 plus 380, which is 3780. So total invested capital will be how much? Your working capital plus your assets, which is 5010. So ROIC will be 921.6 divided by 5010. So 921.6 divided by 5010. Such a simple question. We have done so much, we have talked so much about this during our classes. So such an important and easy question. Nothing could be easier, really. It's a very, very easy question out here. Okay, moving ahead. Any doubt, anybody till here? Rajendra sir, Saranya, do you have any doubt till here? It was very, very simple question. All I did was find my NOPLAT and I divided by my invested capital, operating invested capital, and I got my ROIC. Since no other information was given, so we took operating investments. Okay, next. A company in financial year 25-26 has the following market value capital structure: equity shares, preference shares, debentures, term loan, and corporate taxes. Current market price is 480 per share. Okay, let me just increase the size so it is better visible to all. Right, I hope it is better visible now to everybody. So the question says, I have equity shares with me, preference, debentures, loan, and corporate taxes. The company maintains the above capital structure consistently, meaning I have to maintain this. Assume all cash flows are annual. What is the approximate WACC? Very, very important. Very, very important. It's a very good question for your exam. Because because of just one line, that is the capital structure has to be maintained consistently. Just because of this line, you will have to now this is the complex question. Just because of this line, you will have to make necessary adjustments because you want to make your capital structure as such. Okay, moving ahead, let's make the calculations. I have my 1200 as my market value, that is for equity share. The current market price is 480 and the beta is 1.35. Risk free rate is 6.50. Market risk premium, that is your RM minus RF, that is the return of your market minus the return of your risk free, is 7.8%. I know CAPM model says that return of the market will be equal, return of the portfolio will be equal to return, risk free return plus beta into RM minus RF. This is the formula. So for risk free is how much? 6.5. Beta is how much? 1.35. The market risk premium is 7.8. That is RM minus RF is given to you as 7.8. So you can calculate your return from the market or the return of your portfolio. Return of the equity can be calculated very easily. See, CAIIB, they have calculated it as 17.03%. 6.5 plus 7.8 into, calculate it on your calculator. 7.8 into 1.35 plus 6.5, which will come to 17.03%, right? Absolutely correct. Now the preference shares, the annual dividend is rupees 12 per share. Current market price is 140 per share. Okay. So cost of equity I have calculated. I have to calculate my WACC. WACC formula is cost of equity into weight of equity plus cost of preference into weight of preference plus cost of debt into weight of debt. That is how you will calculate your WACC, right? So my cost of equity I have already calculated. Now I have to find cost of my preference shares, and I know rupees 12 is to be given per share. So cost of preference will be dividend divided by market price. How much are you paying? I am paying 12 rupees per annum for 140 rupees per annum. So what is the cost? 8.57%. I have to pay, this is the outflow and this is the inflow. For every year I have to pay 12 rupees at least for 140 rupees right now. So this is my cost. My cost is 8.57%. That these preference shares मुझको कितने का पड़ रहे हैं? मुझको 8.57% पे पड़ रहे हैं. ठीक है. Now I have to calculate my cost of debt, and for that it's very easy. Cost of debt calculation is very easy. It is 9.2% per annum, which is currently traded at 94% of face value. Okay. So 94% of face value is your market price, which is 0.94. Let's say the face value is X. Okay. Let's say the face value is X. So right now my market value is 0.94X. My face value is X. So right now the market value is 9.94X. Makes sense, right? The coupon is 9.2% of the face value. Of the face value. Always remember, of the face value. And the face value is X. So the coupon is 9.5. 9.2 of X. Maturity is 6 years. Maturity is 6 years and it will be redeemed at par. Okay, maturity is 6 years, redemption is 100%. So what is my cost of debt? So the cost of debt will be how much? 10.2 divided by 97, which is 9.2% of my, let's say the face value was 100. So 9.2 rupees I have to pay it today, divided by how much you are getting right now, which is 0.2 divided by 97. Just give me 1 second, let me calculate it. Okay, so yes, making sense, right? 10.2 divided by 97, which is 10.52%. So after tax will be 10.52 minus, and the tax rate is how much? Tax rate is 25.17. So after tax it will be 10.52 into 1 minus 25.17. So which will be 7.87. So since the interest rate is effectively 10.3%, so after tax will be 7.7. So the total tax will be, there is a loan as well, 10.3%. After tax will be 10.3 minus the rate, which will come to 7.7%. So the total capital is 1200 plus 300 plus 450 plus 350, which is 2300. I can calculate the weights. 1200 divided by 2300. For preference, for debentures, for debt, the weight can be calculated, and I put it into this formula. And it will be 12.71%. C is the correct answer. Any doubt, anybody till here? Any doubt? Anybody? Till here, do you have any sort of doubt? You can go ahead and ask me. Wait, I'll just go away from, okay. I'll just go away from the screen for a second so that you can see the weights. Just to show you the weights. That is 1200, your investment divided by total investment. Total investment was 2300. So that is why the weights, that is how you can calculate the weights. So, and you can put it into this formula and you will have your answer. Put it into this formula and you will have your answer. Okay. Right. Let's take a short break for 5 minutes and then let's come back. Let's take a short break for 5 minutes and then let's come back. If you have any sort of doubt right now, do let me know. I can clear all your doubts. Since these are very good questions and very high probability of these coming in your exam. So yes, not exactly this, but something like this will definitely come in your exam. So if you have any sort of doubt, do let me know. I'll just give you 5 minutes short break. Okay, Rajendra sir has a doubt. KD, please explain. Okay, I'll explain KD to you once again. For those who want to take a 5 minute short break, please, you're most welcome. For those who have any sort of doubt, we can. Okay, just okay. My this was just 1 second. Join the chat. Okay, Rajendra sir, let everybody be back. Then I'll explain it. Okay. Okay, I feel everybody is back since it is one of the important top questions. I would like to repeat it again for KD. Rajendra sir, let's do how did you calculate KD? Since for this question, only KD can be asked. You might get a question if things were simpler, if it's an easy exam, so only KD can also be asked, only KE can also be asked. We have already calculated KE, we know how to calculate KP. Now let's do for KD. For KD there is a specific formula, which is, let me take a new page. For KD you can calculate it by, for KD you need to calculate your YTM, that is yield to maturity. Now KD is an important aspect of your WACC, which will be calculated via a simple formula, that is, which will be calculated by a simple formula, that is I plus RP minus P, that is your interest, annual interest, plus your redemption value minus your current price, divided by 2, divided by n, divided by your redemption value plus your current price divided by 2. Basically what I am doing is, how much interest do I have annually, plus I want to understand if there is any capital gain throughout the life, right? Divided by, this is what we are trying to do, divided by your average, so for my interest I know it will be, for my interest, interest will be 9.2% of face value, always, that I know. Coupon is always on face value, and face value is, let's assume, 100. So 9.2 ka 100, 9.2 rupees. So annual interest is 9.2 plus redemption value is at par, that is 100, minus your current price. Current price is also given to us. The current price is 94% of face value, which is 94 rupees, divided by life is 6, divided by 100 plus 94 divided by 2. So which will come to how much? You calculate, which will come to again as, just 1 second, where's my PPT? Which will come to you as 10.52%. 10.52%. That is why I use 10.52 here. That is why I use 10.52 here with the formula. And after tax, it will be, after tax, this is pre-tax, right? And I have to take after tax for all my debts I have. It has to be after tax. So after tax, it will be 10.52 into 1 minus 0.2517, which will be 7.87%. Simple. Clear now, Rajendra sir? Clear now, right? I hope it is clear to everybody out there. Since this question can be asked, very good question, Rajendra sir. Okay. Next. Again, if anybody feels, those who are watching me on YouTube and those who are watching me on the live class, if you feel I should explain certain concept before again, then I am full ready to do that. Also, if you want to change my language, if you want me to teach in English, just Hindi or English, I can move to that as well, whatever you all are comfortable in, right? Next question. Great, sir. Next question. Next question is question number 8. A bank's ALM team is evaluating the accuracy of its monthly deposit inflow forecast. We want to understand the forecast is how accurate. So the actual is this, forecasted is this. You have to compute mean absolute percentage error, that is MAPE, tracking signal, that is TS, and mean error, mean squared error, and symmetric map. ठीक है. So you need to calculate all these. Actual is given to you this much, forecasted is given to you this much. You just need to calculate your question, whatever is given. Okay, let's do it together then. Okay, for my MAP, I know the formula is simple, which is 1 upon n, sum of A minus S divided by A into 100. That is actual minus forecasted as out of actual. And I need to find the sum of it. So, I calculate the difference A minus F, which is 520 minus 500. That will be 20. 540 minus 520, 560 minus 20, 515 minus 495 plus 20, 550 minus 570 minus 20, 530 minus 525 plus 5, 560 minus 575 minus 15, right? I just need to find the sum of it. Divided by actual into 1 by n. So 1 by 6 of A minus F divided by F, you calculate for, divided by A, you calculate for each. So 20 divided by 520 will come to how much? 0.038. 20 divided by 540 will come to how much? 0.037, and so on. So you calculate these and it will come to 3.115%. It will come to how much? 3.115, and you can calculate, right? For my, so this is done, which is 3.115. So let's see the answer. 3.115. I have, so B will not be the answers, D will not be the answer. I have two options which have 3.115 as two of them. Next I have to find is TS. Okay, for my RSFE, I'll find sum of A minus F, that is minus 10. That is minus 10, right? Minus 15 plus 5 minus 10, because all others are corresponding, they are compensating. So minus 10. For my MAD, that is MAD, I'll calculate my sum of A minus F divided by 6, the mod of A minus F divided by 6. See, this also I have taken into mod, the sum of mod divided by A. That is why here I did not take the negative sign into account, right? Again, for my MAD, it will be A minus F divided by 6. A minus F is how much? 20 plus 20, 40, 60, 70, 80, and 20, 100. So that is 100 into 1 by 6, which will be 16.67. You have to find your TS, which is your RSFE divided by your MAD, right? So let's calculate. RSFE is minus 10. Your MAD is 16.67, which will come to minus 0.60. Minus 0.60. So minus 0.60. This is the correct answer. A is the correct answer. I don't even need to calculate my further things, but still let's do it. For your mean square errors, what I'll do is I'll calculate my errors. These are the errors, right? These are the errors, nothing else. I calculate the square of these. And you calculate the sum. So divided by 6. And last is you calculate symmetric map, that is the average. So 3.5, 0.85 plus 3.64, 3.96, 3.64, 0.94, 2.68. And you get the average 3.12. That's it. It's a very, very, very simple question. It's a very simple question. Right? Chalo. Next. Any doubt till here? Anybody? It was a very simple question. Any doubt till here? Anybody, if you have any sort of doubt, you can ask. It was a good question. If you get questions like this in exam, these are very, very simple questions. All you have to do is you find the deviations, then you find the mode of the deviations divided by the actual figures, and you calculate as per. That's it. It's very simple. Just you need to remember the formula. Just remember the formula and it's very simple. Rajendra sir, is this clear? Next, moving on to the next question. Question number 9. A firm projects FCFF, that is cash flows for available for the firm, right? For 2030 is 145 FCFF, free cash flows for the firm. From 2031 onwards, FCFF is expected to grow at a stable perpetual rate of 4.6%, meaning this is the terminal value, and I need to calculate my terminal value, right? Its WACC is itna and expected to decline by 20 BPS every year for 3 years. Now, this is important. This is very important. It's saying that the WACC is also changing every year, implying the question is difficult. Still here, the WACC was same for us. But now, it's saying that the WACC will also decrease by 20 BPS. There are 100 BPS. 1.1%. 20 BPS, 0.20%, right? Every year for 3 years, implying for the first year the WACC is itna, for the second year it will be itna, for the third year the WACC will be itna, and so on, right? Stabilizing at 11.2 because the first year is itna and it will decline for 3 years. It will decline for 3 years, first year, second year, third year, right? And then it will stabilize at 11.2. Okay. From 2033 onwards. For valuation, analysts use this stable WACC as 11.2. So for analysis, we are using this WACC to compute the terminal value. To calculate the terminal value, we are using this. Of course, even if this was not given in the question, we would have taken this WACC only for our terminal value, because this was the WACC at the time of terminal value, right? However, another team argues that FCFF must first be grown for 1 year before applying the Gordon growth model. Gordon growth model is exactly same. That is P0 is equals to D1 divided by KE minus G. Gordon growth model says cash flow divided by WACC minus growth. That's it. So let's not confuse ourselves and let's stick to one. Let's stick to just one formula. Okay. What should be the correct terminal value at the end of 2030? At the end of 2030. Now, for WACC 2030, it was 11.8, right? And it was decreasing every year. So let's calculate the correct terminal value. Okay. Step number 1 is you calculate the FCFF for 2031. I have for 2030 it is 145. From 2031 onwards, it is expected to grow at a stable rate of 4.6. So this is my terminal value. So I calculate my terminal value, which is 145. As I have told you before, if I'm standing at 0.0 and 1, 2, 3, 4 is at stable growth rate, I can calculate my terminal value here. How do I calculate that? Very simple. That is 145 into 1 plus 0.046 divided by your WACC of that year. That is WACC of that year was 11.8 minus growth. Growth is how much? The growth is 4.6, 0.046. So 0.0118. Which will be 1151.67 151.67, that is 145 into 1 plus 0.46, that comes to 151.46. Now you find the correct WACC. Now the terminal value uses 11.28. So apply the Gordon growth model, which will be 151.67 divided by they are using how much WACC? The analyst says that the WACC to be chosen is 11.2. So 11.2, which is 0.112 minus growth rate. Growth rate is how much? Growth rate is 0.46. 0.112 minus 0.46, which comes to 151.67 divided by 0.066, which will come to 2298.08. 2298.03. So yes, that is the correct answer. This we would have taken for that year, another team's argument, but we want to calculate the correct TV at the end of 2030. So what we'll do is we'll use what the analysts are saying. As I've said before, even if they did not say it, I will use the stable growth rate. I will use the stable growth rate, which will be this. It uses stable WACC. It uses the stable state of WACC. For terminal value, you always use the stable state of WACC. As I said before, even if this line was not given, I would have used 11.2 only. So if I use this, it will be wrong. Right? That is why we are not using this. Okay. Any doubt, anybody till here? Any doubt, anybody? Any sort of doubt, anybody? Please do let me know. It's a good question, and since one simple logic is to be used, that you use stable WACC, stable WACC for terminal values, you will be using 11.2. Okay, moving ahead. Next question that we have is from unit number 14. So unit 13 is all done. Unit 14 will start. XYZ Limited has declared a dividend of 12 rupees. That is, this is DO. It has just declared. The dividends are expected to grow at a constant rate of 7% per year indefinitely, implying I will be using indefinite model. Indefinite model is how much? Indefinite model says PO will be DO upon KE. You don't plus G here, you don't minus G here. You will subtract G over here. So it will be D1 upon KE minus G. Indefinite period. So I have my DO, so it will be D1 upon KE minus G. Sorry, this is the not DO, it's D1, right? This is my model, dividend discount model, and I will use this only. For D1, I have 12 into 1 plus 0.07% divided by K is how much? The required rate is 12%. So 0.12 minus growth is 0.07, and I can calculate it. So using the constant growth model, also known as Gordon growth model, this is what will be done. And it will come to 12 into 0.07 into divided, which will come to 12.84, divided by 0.12 minus 0.07, 256.80. That is why I told you only this method you need to remember. All questions will be done via this simple formula. All questions. Now we will not take much time solving the questions now. Since we have already revised them for unit 13, all units are linked. All of the units are linked. That is why it's such a simple module. Basic logics, and we do the questions. Any doubt? Anybody? Any doubt? Anybody? Okay, next question that we need to do. Question number 2. XYZ Limited has declared a fixed annual dividend of rupees 18 per share. Again, this is DO. The required rate of return for the equity investor has increased due to market condition to 12% per annum in 2025. Okay, this is my KE. Using the zero growth dividend model, calculate the intrinsic value of one share. I need to calculate, there is zero growth, no growth. So simple. What I do is, this is my output and this is my required rate of return, which is increased to 12%. So how much is my intrinsic value? My intrinsic value is nothing but 18 divided by 12%, which is 150, which is 18 divided by 0.12, which will come to 150. See, this is my outflow. This is my required rate of return. So it is 150. B is the correct answer. See, we do not need to spend much time on these questions. Free के number है, बिल्कुल free के हलवा number है यहाँ पर. So simple. What could be easier than this, right? Okay. Any doubt, anybody? If you have any sort of doubt in such questions, do let me know. I'll revise the concept for you if that is the case, right? Any doubt? Okay, moving ahead then. If there is no doubt, moving ahead. Question number 3. XYZ Limited is expected to generate FCFS as follow. High growth for 3 years. Stable growth from 4th year onward. Terminal growth rate is 5%. WACC is itna. Use the two-stage DCF model. The same question we have done before. That is, I'm standing at 0 period. I have FCFFs. First year I have 12 lakhs. Next year I have 14.4 lakhs. Then I have 17.28 lakhs. And then it will grow at a stable rate of how much? 5% per annum. Okay. And my KE or WACC is given to me as 12%. Calculate DCF using the two-state model. Calculate present value at the year end of 0 period. Of course, I need to calculate the present values only. This is what we have been doing. I calculate a terminal value out here. I calculate the terminal value out here and then I calculate the present value of it. Simple. We have already done this question before. That is why I said let's spend some time on that question so that all other questions will be easier for you to solve. Let's solve it then together. Let's solve it then together. First, I need to find the value here. I need to find D1, right? In simple terms, I need to find D4. 1, 2, 3, 4. Then I'll be finding P3 for myself. I'll be finding P3 for myself, right? So let's do it. So first, let's not spend time over this. I'm not doing this with you. I'll be calculating my terminal value. Step number 1, calculate your terminal value. How do you calculate your terminal value? It will be 1728 into 1 plus G, which will come to 1814400, right? You divided by KE minus G, right? Which is KE minus G is how much for me? The terminal value is I said now I'm calculating P3, that is terminal value, right? So which will be T3 will be, let me calculate it for you then. Let me calculate. Very simple. First step number 1, I'll need to calculate my terminal value, which will be dividend 4 divided by KE minus G. Dividend 4 I've just calculated, that is 1814400. KE was given to me as 12%, 0.12. Growth was 0.05, which will come to as 259200000, right? Now I need to find the present value of this. So let's calculate the present values. Either you can do it like this or we can do it directly. how we will do in on the calculators. Very simple for calculators, right? Let's do the calculator version, which is easier to calculate, which will be 12 lakhs, 1440, 1728, and terminal value of terminal value. You can calculate present values for these, which will be 1.1 divided by 1 point, the WACC is 12, which will be 1 divided by 1.12 is 0.89. You 8928, you calculate, you press equals to again, which will come to 0.7971. Calculate equals to again, which will come to 0.7117. For terminal value, it will be 2592000 into 0.7117. See, these two values will be same, always, right? These two values will always be same. Third year and the terminal value, the discounting factors will be same, right? So 1 divided by 1.12123. Correct. Which will come to 1844971. You add both the values and you get two-stage model, 218. Same. I told you that question we spent time, right? Now we don't need to spend any time. Same logic for all the questions. This is two stages. You calculate present value for all these and you calculated present value for this. Two stages, right? Either you do it together or you do it like that ways. Two stages. The answer will be this only. The answer will be this only. Very, very important, and it will come in exam. I am telling you, I can assure you this will come in exam. Okay. Any doubt here? It was very easy to solve as we have already spent time over this in the previous unit. Any question, anybody? Do let me know. Should I solve it for you again? Then I can solve it for you again as well. Just you need to ask. And if not, then I'll move to the next question. If not, then I'll move to the next question. Please do let me know, everybody. Rajendra sir, Lucky sir, do let me know if you need any clarification. I feel we have done plenty question in the class and here as well. We have done it twice now. So there shouldn't be any doubt, but still, if you have any doubt, do let me know. Okay. So, see, the question is such. I think the question is more visible to you now, right? What I can do is I can slightly move my screen for you all. Yes. For my video, I am trying to move. Okay, then the question will be not. Okay. I think this is fine. Right? Better view. Simple question. We have done this before. Okay, next question. Question number 4. A company XY Limited is expected to pay, that is, it is D1. If it has just paid, it is D0, dividend paid at period 0. It is expected to pay, implying this is the dividend which will be expected to pay next year. So D1. The company's dividend are expected to grow at 10% initially for the next 5 years and then the gradual decline to a stable growth rate of 4%. Okay. For the initial 5 years, I already have my D1, D2, D3, D4 and D5, it is expected to grow at 10%. And then after that, it is stable at how much? It is stable at 4%. Right? The required rate of return for the equity investors is 12%. That is KE. Using the H model. Question changed. H model. Calculate the intrinsic value. Very good question. Again. Okay, let's calculate. We know for H model, all you need to calculate is you have your D1 into 1 plus H into your growth rate, which is stable, minus growth rate divided by rate of return minus your growth rate, right? GS minus GL upon this GL. So if I assume my D0 to be 12, which is not the correct answer, my D1 is 12, honestly, if you ask me. But since the question we do not have, I do not have to find my D2, D3, D4, since present value is not to be calculated, I can assume my 12 also to be my D0. Okay, so 12 into the growth, the current growth rate minus the longer period growth rate, stable growth rate, right? So your P0 will be how much? 12 into 1 plus G, that is 1 plus 0, 4, because I have to take GL. R is 12%, N is 5 years, and H, your H will be N by 2. Always remember that. For your H, it will be N by 2. What is N? N is the growth of continuous growth. First period is the N. Continuous growth. Larger growth period is your N. Larger growth period is N. So H will be N by 2. That is 2.5. So it will be 12.48 into 1.15 divided by 0.08. Let's calculate that. Let me do it for you out here. So my D0 is 12 into 1 plus 0.04 into 1 plus 2.5 into GS minus GL, that is 0.06, divided by R minus GL. R is 0.12 minus GL is 0.04, which will come to 12 into 1.04, 12.48, which will come to 12.48 into 2.5 into 0.06, 0.15 in plus 1, which is 1.15, divided by 0.12 minus 0.04, 0.08. So yes, this, and which will come to 179.4. A is the correct answer. A is the correct answer. Anybody, any doubt out here, please do let me know. Anybody, any sort of doubt that you have right away, please ask. Do not shy, because this is a good question. Free marks that you can gain from this question, because it's a direct formula question. Nothing is to be done in this direct formula. Any doubt, anybody, please do let me know. Good question, and yes, it will be repeated. I am telling you, tomorrow exam you will see these questions. You are going to see such questions in exams where this pure formula based question doesn't take more than 2 minutes and 3 marks for you. Okay, next question then. Next question, if no doubts. A company is expected to pay a dividend of rupees 5 per share at the end of 2025. The dividends are expected to grow as follow: 20% for 3 years. Transition is 10% for the next 2 years and 6% for indefinite period. Required rate of return is 12%. Calculate the current value of the stock, that is P0, using 3-stage DDM approach. Same ways that I calculated 2 stage, I can calculate it same ways for 3 stages. Okay. Calculate the dividend for stage 1, high growth. But I have right now of 5 rupees. 3 years will continue at 20%. Okay. So D1 will be 5 into 1.20. D2 will be D1 into 1.10 and D3 will be D2 into 1.20, right? That will be 6, 1.2 and 7.2 and 8.64. This is simple. These are my 3-year dividends. Now, for my, this is the first stage. For second stage, the dividends will be how much? It will be 8.64 into 1 plus the growth rate of that stage, that is 0.10, and so on, which will come to 9.5404. Next will be for 2 years, right? So next will be 10.4544. This is the second stage. For the third stage, it will be terminal value. For the third stage, it will be terminal value, which will be 10.4544 into 1 point, and the terminal stage growth rate is 6% into 1.06, which will come to 11.0817 divided by KE of that period minus G. KE is how much? 0.12. KE is how much? KE is how much? And the growth is 0.06 minus 0.06. This will be your terminal value, which will come to 184.65. Now I calculate what? I calculate their present values. I calculate their present values, which will be the discounting rate will be 12%. Discounting rate is always the WACC percent, the required rate of percent, and I can calculate my terminal values. For the terminal value, the discounting factor will be P5, right? Whatever is used here will be used here. So P5 here, P5 here. See, whatever will be used here will be used here. So yes, whatever is used here will be used here, and rest you can calculate. Very easily, which will come to 133.84. 133. Same question, exactly same question, just the calculations have increased. That's it. Calculations have increased. That's it. Same exact 2-stage question, same question, calculations increased. Any doubt, anybody? Till here, any doubt? If you have any sort of doubt, do let me know. Otherwise, I'll move to the next question. Okay. Then if there are no doubts, then let me move to the next question then. We'll start with the next unit, that is module unit 15 now. Unit 15 was for intangible assets, right? Mergers, intangibles, goodwills, startups. Okay. Analyst A is valuing Alpha Tech Limited using a relative valuation approach. He gathers the following peer groups. All figures in our crores unless otherwise stated. The financials are given to us. Let me increase the size of it so that it's more clear, visible. Okay, we are using which approach? Relative valuation approach. You need to understand the approaches that are used, right? Peer 1, Peer 2 and Peer 3. We have taken our peers, similar companies. We'll use a relative valuation from there and then we'll apply that valuation to us. For us, that is Alpha Tech company, the financial shows net profit is this much, book value is this much, EBITDA is this, sales, debt, cash and shares outstanding. Analyst A decides to compute valuation using 3 multiples. I have 3 multiples with me. PE multiple is what? Your MPS divided by your EPS. P by PB multiple, okay, that is your MPS as per your book value per share, and then EV by EBITDA. We know all three formulas. Now, the question asks you, find the average implied share price. You have to find the average. So what I'll do, I'll calculate all multiples and then I'll average them out. And I'll apply the average to us. This is what we are going to do, right? So let's go ahead and calculate it. Very simple question, but a lot of calculations are involved in this question as well. That is why for ABFM, we say that numericals are important because of the calculations. The concepts are simple. The calculations are there and you have to make the necessary calculations, right? Okay. So for P multiple, for P, what I'll do is I'll calculate for 1 and we can find out. For peer 1, let's do it. For peer 1, the market cap is 18,000. The net profit is 900. Just 1 second. Yes. The market cap is 18,000. The net profit is this na. Book value is itna. EBITDA is this much. Sales is itna and EV itna. Do I know my MPS right now? Do I know my MPS? My market capital is given to me, and market capitalization is how much? Number of shares into MPS, right? So if I know my number of shares, I can calculate my MPS, right? So let's see if we can do it. So your 18,000 divided by 900, right? 18,000 divided by your net profit. Since we do not know our number of shares, we are unable to find our MPS. What we are going to do is your market cap divided by your net profit. It will give you your desired results. So it is 18,000 divided by 920. For peer 2, same ways. For peer 2, same ways, 22,500 divided by your 1120. So one formula I have is MPS divided by EPS. Since number of shares is not given to us, I'm unable to find MPS, right? I can use another formula, that is your market cap divided by your net profit. Since number of shares is not given, net profit divided by number of shares would have also given me my let's say why this formula is making sense. Let me talk about that. Okay, let's say the number of shares is 100. Okay, let's say the number of shares is 100. For example, my market capitalization is 18,000 divided by number of shares 100. This is my MPS. For my EPS, the EPS formula is EBIT minus I, that is your EBT minus your taxes, will give you EAT divided by number of shares, right? Now I have my net profit. I have my EAT, net profit. Since tax is not given, this will be my net profit, that is EAT, profit after tax, is given to me, which is 900. And I have assumed number of shares are 100, right? So divided by 100, which will be my EPS. I know MPS divided by EPS will give me my PE ratio. So what I am doing is, if you see essentially, it is 18,000 divided by 100 divided by 900 divided by 100, which will be 18,000 divided by 100 into 100 divided by 900. Is this not giving you 18,000 divided by 900, which is market capital divided by net profit? That is why I said this formula makes perfect sense. Same ways I can calculate for peer 2 and peer 3, right? So I'll calculate the average of these, the P average EV will be calculated. So I have my first multiple with me, that is average PE ratio. Second is PB ratio. So average P book value ratio I'll calculate 18,000 divided by the book value is also given to us. The book value is how much? 7,200. 7,200 for fun. Same ways for second, same ways for third. I can calculate. So I will have my average PB. Third is EV by IPTA. EV is also given to me and IPTA is also given to me. EV is also given to me and IPTA is also given to me, which is 2,500 divided by 2,400. 2,500 divided by 2,400. Same ways, I can calculate for all peers and I can calculate average EV by IPTA. Now I'll have to apply these averages to my own company. Okay, so I using valuation of PE, equity value will be net profit into average PE. Since average PE is applied to net profit, so I can calculate my market price, right? I have to. The question says find the average implied share price, that is market price. So PE ratio is MPS divided by EPS, right? So if I apply EPS into PE ratio, I'll get my MPS, right? I will get my MPS. This is what I'm doing. EPS I don't have, I have net profit. So net profit into average PE, which will come to 21.03, 1.05. So price per share will be 21,031.5 divided by 42. Why divided by 42? Since we are given here that there are 42 crore shares for us, we know our outstanding shares, that is why. Okay, net profit for us is given as 1050, right? So 1050. Applying the value of PB, same ways I can calculate book value into average PV. So the book value is how much for us? 8,500. So 8,500 into average PB, which is this much, which will come to 507. And for valuation of IPTA, I have my IPTA into average, which will be the enterprise value will be 483.29. So average of all these three, 501 plus 507 plus 483 divided by 3, 497. 497. So D is the correct answer. D is the correct answer. Anybody who's unable to do this question, this was also a very simple question, but yet again important for exam. It will come in your exam. I'm telling you that this will come in your exam. This is a good question and will be asked in your exam. Any doubt, anybody till here? It's a good question. How are we calculating? See, I'll do it once again for you. What did I do here? Just for clarification. In relative valuation approach, what happens is you calculate multiples. You take your peers, let's say 2 to 3 peers, you take similar industries, similar companies in the same industry. Their values are given to you. You calculate multiples using these companies and then you apply these multiples to yourself, right? So I have 3 companies. For my PE ratio, I calculate average PE of these companies. For my PB ratio, average of these 3 and EBITDA average. I apply these averages to myself and then I take an average of these 3 averages. I'll have an implied share price for me. I'm working on averages here. Got it? That is how we calculated. I calculated PE for all 3, took average for this. I calculated PB for all 3, took average for this. I calculated average EBIT, took average of this. Now I applied average of average PE to myself because the formula is what? The formula is, the formula for PB ratio is, PE ratio is market price divided by EPS. So if I do PE into EPS, I'll get my market price. That is why net profit into this. Now, if I apply it to book value, that is MPS divided by BVPS. Now, book value into PB, average PB will give me my market price. That ways I calculated this. And for my enterprise value to IPTA, I'll have my enterprise value. So, enterprise value divided by IPTA. I have my average. I applied this average to IPTA. I'll have my enterprise value. And I have unit A with me, unit B with me, and unit C with me. I calculated the average of A, B, C. That was my implied share price. This is what I did. Simple calculation can be done on the calculator within minutes. Within minutes, you can do it. Okay. Next question. Question number 2. A company in 2025 has the following data. Cost of equity is this. ROE, that is return on equity, is this. The dividend payout ratio is 42%. So how much is retained? 100 minus 42. That is 58 is retained. Retention ratio is 58%. Okay. Expected EPS for the next year is 48. Okay. Compute the approximate current price of the share. So current price is how much? P0 is D1 divided by KE minus G, right? This is the expected ratio. I don't know my G. When I don't know my dividend, it can be replaced by my EPS. So EPS 1 divided by KE minus G. EPS 1 is known to me, which is 48. KE is also known to me, which is return on equity 18.6 minus your growth rate. What is your growth rate? You tell me that. Growth is nothing but your retention ratio into your ROE. Retention ratio into ROE is your growth. So 1 minus B into your ROE. It will give you your growth. So 48 divided by 0.186 minus 1 minus B. B is your dividend payout ratio. Dividend payout ratio. So 1 minus B is 0.58 into your ROE. ROE is how much? 18.6 into 0.186. This will give you your P0, which will be, see, same formula, 1 minus B divided by your R minus ROE minus B, 1 minus payout ratio, right? So 42 is your payout ratio. B is 0.458. So R minus this will come to how much? 0.42. 0.42 divided by this. So your current market price can be taken out. They took a longer route. This question, the solution, they took a longer route, if you ask me. They took a longer route of finding out your this thing, PO. I would have very easily determined my PO from the single formula that we have. That is D1 divided by KE minus G. Either what they have done is, in the solution that I have shown you, it is PE is equals to PO upon EO, that is MPS upon EPS, right? EPO is your MPS, current market price, divided by your this thing. So current market price I don't know, so PE into your E1 will be your P0. This is what they have done. So I can very easily find out my E1 and PE ratio, which is, for PE ratio they have given you a formula, 1 minus B divided by R minus ROE into B. B is your retention ratio. B is your flowback ratio, which is retention ratio, right? And I know it. I can very easily take it out here, right? Let's which is 0.58 into ROE. Your retention ratio 0.58 into ROE. ROE is how much? Your ROE is 18.6. So 18.6 into 0.58. Very easily. You don't even have to remember all these formulas. I am telling you, work with logic. So your D1 was not given to me, but my EPS was given to me, right? Which was 48. Okay. 48 divided by KE minus G. KE is how much? KE is 18.6, right? KE is how much? KE minus G. G I don't have. G, but growth rate formula I have. That is retention ratio into return on equity. Retention ratio in your your cost of equity is R. That is 14.8. It should be 14.8. 148 minus your R, return on equity, into RR, and you could have very easily solved it. You don't even have to remember. I'm telling you, don't have to remember all these formulas. One formula is more than enough to calculate everything. Everything. So the current price is 502. B is the correct answer. Any doubt, anybody, till here? Very good question and very simple formulas. Very simple calculations, very easily. You don't even have to remember the formula. One formula is more than enough for you. One formula is more than enough for you. I am telling you that. The growth rate you need to find out, right? Growth, simple formula, always remember retention ratio into your ROE. Retention ratio is how much? Retention ratio is 1 minus dividend payout ratio. 100 is the total earnings. Out of this, I retain something and I pay something, right? So retention will be 1 minus payout. That will be retention. If retention is given to you and you want to find out your payout, so 1 minus retention is your payout. Simple. Right? Any doubt till here? Because this was a good question. Any doubt? Anybody? Any doubt? Okay. Okay, I am going away from the screen so that it is more visible to you at what I have done in the question. It's a very simple question. Even if you don't want to go by this and you want to learn the formula, simple. Okay, let's then move it. Then let me tell you the formula as well. The formula says nothing but P is equals to your MPS upon your EPS. If you don't have any, which it will be 1 minus B divided by R minus ROE into B. B is your retention ratio. So 1 minus B isn't 1 minus B your dividend? Isn't this your dividend? You tell me, isn't this your dividend? Which will be how much? Dividend is how much? Dividend is D1 divided by R is your cost of equity into your retention into ROE into retention is growth. Isn't this the same formula for PO? Isn't this the same formula? Why do you have to learn 10 formulas? It's the same formula, bete. It's the same formula, understand? Right? I don't want to learn 10,000 formulas. You have your PE multiple very easily. You have your PE multiple with you. D1 I have with me. I have my D1 with me, which is 0.42. Given directly, dividend payout ratio is 0.42. 0.42 divided by R is 0.148 minus G. For G, I can calculate. G is ROE. ROE was how much? ROE was how much? 0.86. 0.186 into G. G is into B. B is how much? B is your retention ratio. That is 0.58. Into 0.58. You will have the same answer. Same answer I am telling you. See, 0.148 minus itna. If I calculate 0.186 into 0.58, it will come to this much only. 0.186 into 0.58, it will come to 107888. Right? So this is, you don't need to remember all these things. Honestly, I'm telling you, you don't need to remember so many formulas. Don't remember. You need to just follow one formula and you have everything with you. Follow one question, one formula, and all the answers will be given to you. So the multiple came out to be how much? 0.42 divided by this much, which is 10.47, into your EPS, which was given to you, will give you your current price. Will give you your current price. So one formula is P0. P0 you have with you, and you have your EPS. So this will be your PE ratio into your EPS is given to me in the question as 48. So into 48, I can very easily calculate it. You don't need to remember. I'm telling you, don't remember. Don't go into intricacies of so many formulas. You will otherwise make mistake. What you need to do, follow one formula and the answer will be yours. Very easily you will have your answer. Right? Chalo. Moving ahead then. Moving ahead. Next question that I have for you. A company, Novatech Limited, reported the following for financial year 24-25. Current market price, diluted EPS. The company recently issued guidance indicating your revenue CAGR is 12%. Net profit margin improves by 80 BPS, that is 0.8% next 2 years. Diluted EPS and peer companies in the same sector have this much. The PEG ratio is this much. Based on the above information, what is the PEG ratio of Nova? Okay, very simple. So I can calculate my P ratio. My P ratio can be calculated by MPS upon EPS, right? So MPS is 1260 divided by your EPS. That is see, you for my PEG I need P ratio, I need my revenue, I want to understand my EPS growth rate. Two things only I need, right? My P ratio for PEG is P divided by EPS growth, right? So for my PE, I have my current price as 1260 divided by EPS, which is given to me as, even if it is diluted, doesn't really have any other, I don't have problem with diluted. I never said I have to take diluted EPS or undiluted EPS. We never talked about that. Any EPS can be taken. So I have taken this EPS, 1260 divided by 36, which will come to 35. This will be my P ratio. And for my PEG, I know PEG is PE divided by EPS growth, right? My growth rate, right? So I know that I need to calculate my growth now. For my revenue, CAGR is given as 12%. For my revenue, CAGR is expected to grow at 12%, making sense. And EPS CAGR is 1.2 of my revenue CAGR, right? 1.2 of my revenue CAGR, which will be 1.2 of 12%, which is 14.4%, right? This is my EPS. This is my EPS CAGR, right? 14.4. So for my EPS, the growth rate is, CAGR is how much? 14.4. So PE came out to be 35. EPS growth rate will be 14.4, which will come to 2.43. 2.43. So 2.43 should be the answer. A should be the answer. Correct, right? Okay. Right, making sense. Making sense. I have my CAGR for my EPS, which is revenue into 1.2. Revenue CAGR into 1.2. That is my growth rate for my EPS, which came down to 14.4. Just apply it to the formula. Just apply it to the formula and you have your answer. You have your answer with you. Simple. Any doubt, anybody? Any doubt, anybody? It was a good question again. Any doubt? Okay, no doubt. Then I'll move to the next question. Okay, wait. What I'm going to do is I am going to adjust my window to be smaller in size so that you can accordingly change. So I'm going to stop the streaming for. So I'm very sorry, but I am unable to scale myself down somehow. But no worries. Let's continue with our questions then. Right? Questions are most important for us right now. So moving ahead. Next question that I have with me. Yes, let's see if the question, yes, I calculated my PE, I calculated my EPS CAGR, and I applied the formula, and it is 2.43. It is 2.43. Next question. You are analyzing Alphatech Limited for 24-25 and the sector average metrics are given to us. You are required to compute the relative PE ratio. Relative PE ratio. I've already told you how to calculate your relatives. Your relative PE ratio. How do you calculate your relative? For relative ratio, what you do is your base sector PE into your GA divided by GS into your ROE upon your ROE, ROE of adjusted divided by S into 1 minus payout of A divided by 1 minus payout of S. We know that, right? We know that for sure that this is how it is to be done. We know the formula already. All we need to do is we need to put it into the equation now. Let's go ahead. Let's go ahead and do it. Okay. So I am going to go away from the screen. That is the solution that I have for you right now. And we'll try to solve the questions. Okay. So the averages are given to me for sector average and my average, right? Sector average is for us, the average for market price is 1020. For a sector we do not have. For EPS, for self is 34, for the sector is 28. Expected EPS for the next 3 CAGR is 18, for the sector is 12. Return on equity is 19% for us, and for the sector we have is 15. For dividend payout ratio, 22% and 30%. Let's put it in the formula. The base PE is 21.5. We already know that, right? And we have to be using the weight average method, weight adjusted method. Okay. Anyhow, if it would have not been given, I would have taken this only, right? So let's compute it together. My PE ratio will be MPS divided by EPS, which is 1020 divided by 34. 1020 divided by 34, which come out to be 30. I just need to put it in the formula. Yes, this formula you need to remember. Let's, there are so many formulas in ABFM. Let's put our energy towards the formula which makes sense, So yes, you need to remember this formula, and the formula says that you take the base sector PE, which is given to us as 21, into your GA upon GS power 4, because the growth rate is given to us as 4, right? For the next 3 years, right? Into ROE A divided by ROE of the S, 0.4, into 1 minus payout A divided by 1 minus payout S, 0.2. So let's do it. So the growth factor will be 1.5, 0.4, right? Which is 1.76. ROE factor is, growth factor is 18 divided by 12, 18, 12, which is 1.5 divided by 0.4, 1.76. ROE factor will be, ROE is 19 and 15, which will be 1.2667 ki power 0.4, which is approx this much. This, and for retention factor we have 1 minus payout. Payout is 22 and 30. 22 and 30, which will come to 1.1143 power 0.2, which will be 1.022. And the adjusted P, we can put it into the formula, that is 21.5 into 21.5 is the formula, 21.5 into your retention factor, growth factor, that is 1, into your retention factor, ROE factor, into your retention factor, which will be 28.35. So relative PE will be your adjusted tech PE divided by your adjusted sector PE, which is 28.35. So your PE divided by your adjusted factor PE, which is 28.35, which will come down to 1.058. 1.058. Any question here? I feel this question is a question which might be problematic, since there is a new formula that you need to take care of. You will have to take care of that formula. You cannot help it, right? Chalo, theek hai. Moving ahead. Okay. Your own divided by sector, your own divided by sector, your own divided by sector. Simple. It was simple. Just you need to remember the formula, right? Oh. Any doubt, anybody? If you have any doubt, please do let me know. Any doubt, please do let me know. The previous chat was not visible to me. If you have any doubt, please write it again. If you have any sort of doubt, please write the question again and it will be visible to me. Right? Important question, adjusted PE, we have done. Next question is, a company reports the following information. Opening BV is this much. Net profit after tax, that is PAT, is 84 crores. Equity share capital is 28 CR and face value is 10. DPS is 4. Cost of equity is 14%. Expected sustainable ROE, that is your from financial year 25-26 is 18%. Okay. Dividend payout ratio remains constant. Can I find my growth ROE into retention? Retention will be 1 minus your payout. Payout ratio is how much? Dividend payout ratio is rupees 4, that is 4%. 4 for 10, it is 4%. 4% is your dividend payout ratio. Sorry, 40% is your dividend payout ratio. Rupees 4 was paid. Rupees 4 was paid. Why did you, now you understand why did they give you face value out here? And they gave you how much dividend is also given. So what X percent of 10 is rupees 4. So X percent will be how much? 4 divided by 10, which is 0.4%. 0.4, which is into 100, of course. 0.4 into 100 will be 40%. So your retention will be 60%. Your retention will be 60%, right? Residual income is expected to grow at 3% per year. Using book value residential income approach, estimate the intrinsic value per share at the beginning of financial year 24-25. So let's calculate it. I know my VO, that is intrinsic value, will be equals to BVO plus RI divided by KE minus G. RI is what? ROE minus KE, right? For my VO, it is the formula is BVO plus RI upon KE minus G, right? So VO minus BVO will be your RI upon KE minus G, your residential income minus G. So BO minus BVO into KE minus G will be your RI. Simple formula, right? Simple formula, right? So I can calculate my RI. Okay. From here I can calculate my RI. So number of shares is 2.8. EPS will be how much? EPS will be your NAT 84 divided by number of shares. Number of shares will be 28 divided by 10. 2.8. 84 divided by 2.8, which is 30, right? Which is 30. Your dividend payout ratio is 13.33. Since I have got my EPS as 30, so dividend payout ratio will be either 4 divided by 30, or you could have taken it on face value as well. So your payout ratio can be calculated on your EPS. Since we have calculated EPS, we can calculate it on that ways also. So retention will be 86.67. ROE 1 is 18%, which is already given to us. 18% is already given to us, right? So I can calculate my RI, 0.18 minus 0.4 into 210, which will come to 8.40. So VO will be 8.40 plus 8.41 divided by 1.4 divided minus 0.03, which will come to 286, which will come to 286.36. 286.36, right? Okay. Simple question. This was also very simple. Any doubt, anybody till here, do ask. If you have any doubt, anybody, you can still ask. See, if EPS information was not available, then I would have done it like I was telling you during the question. I would have calculated my DPS on the face value. But since we calculated EPS, now dividend payout ratio makes more sense since it is paid out of EPS. That is why DPS is not on face value. That is why DPS was not calculated on face value. Since EPS was there, that is why DPS is not calculated on face value. Always remember the DPS, the payout ratio will be on EPS. Okay. Since you are paying dividend out of EPS only, right? Dividend is paid out of EPS. You calculate EPS and you pay some dividend and retain some, right? That is why for calculating my dividend payout ratio, I am calculating it on EPS, 4 divided by 30. That is why. That's the only reason why we did it. Got it? Now tell me, any question, anybody? Important question. This was also a good question. Can be asked in exam. Next question. Financial year 25-26, consider the following information. MPS is this much. Outstanding equity shares. Okay, I can calculate my market cap. Market value of debt is given to me, listed bank loans, cash equivalent is given to me, IPTA is given to me, ROIC is given to me, WACC is given to me, growth rate is given to me, depreciation as of percentage of IPTA is 18%, and corporate taxes are also given to me. Find the EV and EV IPTA. Very important question. Very, very important. A lot of calculations. No. No, not a lot of calculations. It's so simple for us. For my EV to IPTA, it is such a simple question and will be asked in your exam. So how do I calculate it? It's very, very simple. All you need to do is apply a little bit of logic out here. If you remember what we studied in exam, it will be very, very helpful. So my enterprise value is how much? Value of my equity plus market value of my debt minus your cash. That is my enterprise value. But that right now, if today I have to pay people, my equity people also, my debt people also, right? Minus how much cash I already have. This is the value of cash that I need to bring more cash, right? See, I need to pay, let's say I have to pay 10 lakhs to my equity people as per the market value, plus 20 lakhs to my debt people as per my market value. So how much do I need to pay in total? 30 lakhs. 10 plus 20, 30 lakhs minus already available cash with me. That is how much of more cash I need, right? That is how much of more cash I need. That is your enterprise value. That is your EV, market value of equity plus market value of debt minus your cash. So do I have my market value of equity? Yes, I have my market value of equity. My market cap. My market cap 640 into 60. So 640 into 60 is my market value of equity plus the market value of debt. That is 140 plus 70. Right, which will come to 640 into 60. Do it fast. 38400 plus 140 plus 70, that is 210. It will come to how much? 38610. 38. Oh, sorry, 60 lakhs was given to me. This was 60 lakhs, so 0.60. 640 into 0.6. See, this is in CR and this is the market price into 60 lakhs. Market price, this is 60 lakhs and this is CR. This is in crores and this is in lakhs. So I'll have to convert this also in crores, right? 384. 384 plus 210, which will be 594. 594 minus your cash, and cash is 55, minus 55, which will come to 539, which will come to how much? 539. So your EV is 539. So wherever you have 539, those two options will be correct. This is correct, this is correct. One of these will be correct, right? And your IPTA, for your IPTA, you have 125 as your IPTA. It is already given to you as 125. So divided by 125, which will come to 4.32, 4.312. So A is the correct answer. A is the correct answer. Right? Easy, right? Very easily we were able to do this question. Okay, I'll again go away from the screen so that it is more visible to you all. Right? Right? Easy question, very easy. Moving ahead, next question that I have for you, question number 7. So yes, that is how we did it. A company, Delta Nova Limited Industries, has the following financial parameters. Corporate tax is given to me, reinvestment rate is given to me, that is retention. Retention ratio is given to you. Weighted average cost of capital is given to you, expected growth rate is given to you, and expected EBIT for next year is given to you. Calculate EV by EBIT. So simple. So simple. Couldn't have been simpler. Couldn't have been simpler, and free marks for you all. Free marks, I'm telling you. Such a simple question. Couldn't have been simpler. Such a simple question. Let's do it together. Let's do it together. So I have my reinvestment rate with me. I have WACC with me. I have expected growth rate with me. Can I calculate my EV? I know that EVO divided by EBIT1 will be your EVT, right? For EV by EBIT multiple, EVO divided by EBIT1. This is the EV EBIT multiple, right? This is the multiple that you take enterprise value today and you take EBIT coming next year, which is given to me already 520. Right? It is already given to me as 520. Okay. For my EV, I can calculate, since nothing else is given, I can very, very easily calculate my this thing. I can calculate my EVO by a simple formula, that is 1 minus T into 1 minus reinvestment rate. Right? 1 minus T is how much? Without tax, how much you have, into 1 minus reinvestment is your dividend. Right? That is your enterprise value. That is your enterprise value. That is E minus T into 1 minus residential value, reinvestment rate. Reinvestment rate is how much? Retention, divided by WACC minus G, which will be 1 minus T is 1 minus 0.28 into 1 minus reinvestment, that I want to know dividend after taxes. So dividend is 1 minus 0.62. That is after tax what dividend I have, right? So which will be 1 minus T into 1 minus retention 0.72 into 0.38, which will come to 0.2736. 0.72 into 0.38, which will come to 0.2736, right? For your denominator, you have your WACC minus G. WACC is given to me as 14.8 and G is 10.6, which will 0.042, which will be 0.042, which will come to this, which will come to 6.514. 6.514. So B is the correct answer. Yes, for this you should remember the formula. This is something you should remember the formula, because this cannot be solved if you don't know the formula. Honestly, for logic also, for this also, I have given you the logic in the class, that it is nothing but in such questions, what you do is your enterprise value can be calculated by your dividend, which is 1 minus retention. Reinvestment is your retention, right? Into, after you want to take after tax value, so into 1 minus T divided by your KE minus G. That is your KE minus G, right? If you take, essentially in such questions, it is nothing but, see, it is nothing but, the formula is simple. Such questions, it is nothing but D1 upon KE minus G. Honestly, when you don't know D1, for my enterprise, it will be D1 after tax divided by your KE WACC minus G. Is this not the formula? Is this not the formula? This is exactly the formula that there is. 1 minus t, because I'm taking it after taxes. After taxes, so 1 minus t into d1. d1 I don't have because I have only reinvestment ratio. That is the retention ratio. So 1 minus retention is how much? 62.62. So 0.28 I am 0.28. 1 minus 0.62 is 0.38, sorry. 0.38 I am paying out as dividend. I am paying out as dividend, and I want to calculate after taxes. After taxes, the tax implication divided by KE minus G. One simple formula applied everywhere. Applied everywhere. Honestly, just apply some logics and you will be able to solve it. Just apply some logics and you will be, or believe me when I'm telling you this, you will be very easily able to solve this. Any question, anybody, please do let me know. Any doubt till here? Okay, then moving ahead. Next question that I have with me is, a valuation analyst is estimating the fair EV by FCFF multiple for the company. The following projections are: FCFF for 2024 is 480, expected growth rate is 4.8, WACC is 10.6, long-term stable growth rate beyond next year is this itna. So I need to calculate my terminal value, find the EV of the firm, EVO. Same formula, exactly same formula. EVO divided by FCFF 1, right? So 1 upon WACC minus G. 1 upon WACC minus G, which is 480 for today, and the growth rate is how much? 4.8. So 1 plus 0.48, which will be 503.04, right? EV upon ECFF multiple, which will be 1 divided by WACC minus G. Stable growth rate, right? Which will be the stable growth rate also remains same. The terminal value is same because it is indefinite, na, same. Over both the periods, the stable growth rate is same. So which will be 1 upon WACC minus G. Simple formula, which is 1 upon 0.106 minus this much, which will come to 17.24. 17.24. So EVO will be 503. We have just calculated into 17.24. We'll get my EVO. We'll get your EVO. Very simple. Very, very simple. Right? Any doubt till here? Any doubt? This is also one formula only. You ask me, I can prove it to you here as well, that this is also one formula only. See, let me prove. Your enterprise value is what? Your PO is what? D1 upon KE minus G. Right? This is my this thing. Can I write PO upon 1 is equals to D1 upon KE minus G? Can I write this as PO upon D1 is equals to 1 upon KE minus G? Can I write this formula as this? I can. So PO divided by D1 will be equals to 1 upon KE minus G. Can be written, right? So PO, I don't know what is my PO. That is the enterprise value. Divided by your D1. I know my D1, which is 480 into 1 plus 0.048, which is equals to 1 upon WACC minus G. WACC is 0.06. 106 minus 0.48. Can I not find my PO? I can. So just one formula and you are using it everywhere. So you don't need to remember a lot of formulas. You remember one formula and everything will be solved. Believe you me when I'm telling you that. In our classes also, we have done that. Every formula was derived from one formula. That is why I ask you, never learn formulas, go by logics. Next question. Okay, so the answer will be 8672. 8672, which is option number A. Next question. A valuation analyst is reviewing Suryodaya Tech Limited. The company reports the following: ROIC is given to me, growth is given to me, and WACC is given to me. The analyst argues that the firm is transitioning to a capital light model and therefore the ROIC is expected to decline. Okay, makes sense. Since the capital is going on the lighter model, so ROIC will decrease. The denominator will decrease, that's why, right? By 0.6 percentage. By 0.6 percentage points. Okay. While the WACC is likely to increase by 0.3 percentage points. Okay. Due to rising interest rates. Growth is expected to stay the same. Okay. Growth rate is expected to stay constant. Find the revised estimate using EV-BV model, that is enterprise value divided by book value model. Very simple for this also. I know my formulas and I can solve it. EV by BV is ROIC minus growth divided by WACC minus G. Same formula. Same formula. Same formula for ROIC minus G divided by WACC minus G. And I can calculate. WACC is ROIC is 21.6 minus your growth rate, that is 9.2, divided by your WACC, which is WACC is given as 12.4. Acha, sorry, you will have to take revised ROIC. Revised ROIC is declined by 0.6. So 21.6 minus 0.6, which is 21. And your WACC will increase by 0.3. So 0.127. Revised you take and you put this into formula. Yes, this formula remember. This formula you should remember, since this is a formula that you'll have to use in the exam. It's a direct formula question. This you should remember. This is something you should revise tomorrow. Next question. A valuation analyst at Zen Matrix Technology is estimating EV sales multiple. Financial projections are after tax operating margin is 14%, growth rate is 11, reinvestment rate is this much, so dividend payout is 1 minus 62%, 0.62, that is 100 minus 62 is 38%. WACC is 60. Find the EV by sales multiple. This is again also very simple question. Directly from formula we can do it, which is after sales operating margin, EV by sales into 1 plus G into 1 minus reinvestment rate, that is your dividend payout, that is your DO, into 1 plus G into your after tax margin. The logic I told you in exam was, I want to find, in the class was, I want to find my D1 into your after tax operating margin divided by your WACC minus G. This was your EV by sales. I told you the formula for this as well, the logics for this as well. So D1 can be written as D0 into 1 plus G. And D0 is what? D0 is what? 1 minus retention. Right, that is why. So it's not a difficult formula. It's a very easy formula. Just move with logic and easier to remember. Move with logic, easier to remember. And the answer will be option number B. Option B is the correct answer. Any doubt, anybody, please let me know. Any doubt, anybody, please let me know. Right? Again, this is also pure logic based. Same formula, just I want, since it is with sales, so I want to take after tax operating margin. In our classes, we did that every formula has a logic, and this was the logic behind this formula. Next, unit 16 we will start. For that, I'll give you a 4-minute break and I'll meet you exactly at 11. And for another hour, we will we doing our numerical questions, whichever question, like how I have prepared all numericals for all 3 units, but I'll respect the time as well, because post 12 I don't want you to be wake up. You have just round there, so don't worry. What we'll do is we'll come back at 11, and then for the next 1 hour, how many questions, whichever number of questions we'll be able to do, we'll do it. we have taken a good break now. So let's start with unit 16 now. Module C, unit 16. Okay. Everybody, please, am I audible? Please let me know. Am I audible to all? Okay. Then let's start. And the question that I have for you is, and the question is, question number 1 for module C, unit 16. A company is being valued using FCFF model. Let me increase the uh, size for you. A company is being valued using FCFF based DCF. Okay. At discounted cash flows. Simple. You are giving free cash flows. After 2029, cash flows are expected to grow at a stable perpetual rate. Same question that we did in unit 1. Same here. Same, exactly same. So I need to find out terminal value and then discount it. Right? Capital structure is also given to me. Cost of equity is there. Pre-tax cost of debt is there. Corporate tax rate is given. DE ratio is given. That is debt upon equity is given to me. So total outstanding debt is given to me. From here I can find out my equity. Cash and cash equivalents are given to me. Share outstanding are given to me. Find out the intrinsic value. Very, very, very simple. All you need to find is move by logics and you'll be able to do the question. Good question and worth repeating in exam. So yes, there are high chances that this question will be there in your exam. Okay. So let's do it together. Let's do it together, right? First, let me give you some logics for this question. Then we can solve it. So first I have been given D ratio, that is debt upon equity. From there I can calculate very easily. I can calculate the weights and how much is my equity, right? So for my weight of my capital structure, let's suppose that my D will be equals to 0.6 of my E. So total capital will be D plus E, which will be 1.60. The total weight is this much, right? The total is this much. I have to calculate the weight of my D. I have to calculate the weight of my E. So the weight of the D, that is debt, will be equal to percentage of debt divided by total D divided by 1.60, which will come to 0.625. For equity. For debt, it will be 0.60 divided by 1.60, which will be 0.35, or 1 minus 0.625. Simple, right? I can find out the weight of my equity. 1 minus weight of equity will be my will be the weight of my debt. Makes sense, है ना? Then I can calculate my after tax KD. After tax, because in my calculations I need my VAT, and for VAT I need after tax KD, right? So KD is how much? KD will be the percentage that is given to me as 9.2, right? The cost of pre-tax is 9.2. I can calculate post-tax, that will be 9.2 into 1 minus your tax rate, and tax rate is 25%. So 1 minus 0.25, which will come to around, let's say 6.9, approx 7% आएगा आपका ये KD, correct? I have a KD, I have my KE. KE is also given. I have weights. I have just calculated the weights. I can calculate my VAT. From VAT is my discounting rate here. If KD, tax rate, this all was not given to me, I would have directly taken KE that was given to me, and I would have used that as my discount rate. Since so much information was given to me, I had to calculate VAT, and VAT is to be used as my discounting rate, right? I can use my VAT, since calculated VAT into your present, I can calculate my present value from there. I can calculate my terminal value, and simple, go ahead. Very, very simple question. Exactly same, since Same question we did in unit 13, same question we did in unit 14, same question we are doing now. But the only difference is we have never calculated WACC. The weights of KD and KE is still here. Now we'll be doing that. Now we will be doing that. So let's suppose I know my debt upon equity is 0.6. So debt will be 0.6 of equity, right? This I know. So I know debt plus equity will be total capital. So debt is how much? 0.6 of equity plus equity, which is equals to 1.60 of equity. This is my total capital. My total capital is 1.60, right? So for the weight of my equity, it will be equity upon total capital, which is equity divided by 1.60. Total capital is 1.60 of equity, which will come to 0.625, which will come to 0.625, right? So this is the weight of equity. So for weight of debt, it will be 1 minus 0.625, which will be 0.375. I have my weight of equity. I have my weight of debt. Can I calculate my WACC? Yes, I can calculate my WACC. I have the weight of my debt. For my cost of my debt, it will be 9.2% is already given to me into 1 minus your tax rate, which will come to 6.9%. And I can calculate my WACC from there. For my cost of equity was already given to me 11.21. I can apply this discounting rate and I can calculate the present value of three cash flows with different growth rate. I can calculate my terminal value as well. For terminal value, it will be 60 into 1.04 divided by WACC, which is 11.2, which is 0.1 minus your G. This will be my terminal value. This will be my terminal value. And I'll have to discount it. I will have to discount it. Yes, terminal value is this. Terminal value is this. 62.4. Why they have taken 62.4? 62.4. Right. 62.4 divided by this. Now I'll calculate my discounting factor to it. Same discounting factor will be applied here. And my enterprise value will be, you add both of them. So enterprise value will be calculated. So for value per share divided by number of shares, which will come to 47.11. B is the correct answer. Now tell me, anybody, any doubt till here? Since it is such a easy question, same logic that we have been applying since the very first minute of this class, we are doing the same method now. Right? Any question, anybody, do let me know. Any question, anybody, do let me know, please. Okay. Next question. Now let's do next question. That is, a company, Zentrix Motors, provide the following projected financial data. Project revenue, 4,800. For 24-25. For 25-26, this much. After tax, operating tax, that is no PAT, is this much. Invested capital is this much. Sales to capital ratio is given to you. Retention ratio is 1. The firm reinvests all the reinvestment required. Okay, so there is no dividend. Simple. D1 is 0. Based on the above data, expected growth rate you have to find. Very, very, very important question. Since there is no dividend payout, how do you calculate in certain questions? What I can do is, I can calculate my expected growth via my EPS then. Since there is no DPS, I can calculate there is some growth in EPS, right? There will be some growth in revenue. There will be some growth in earnings per share, etc., etc. Doesn't necessarily has to be D1. It can be EPS. It can be revenue. Anything, right? I just have to discount it. Okay. So change in revenue will be how much? 5520 that you have right now minus 4,800. That is the change in expected change in the revenue, around 720 CR, right? That is 5520 minus 4,800, around 720 CR is the change, Correct? Then you have your computed expected reinvestment. Sales divided by your capital will give you your reinvestment rate, right? So expected reinvestment can be taken out from here. Makes sense, right? Then my reinvestment rate can also be calculated. Okay, so somebody has raised their hand. Manish, hello. Anything that you want to add? Manish sir, anything you want to add here? Am I audible to you? Okay. I think I was not audible here. Right? Okay. Just give me 1 second. Let me check on YouTube as well. Point 0.6 of equity. Okay. Right? Okay. Let's do the question directly now. From my sales to capital ratio, I can calculate my reinvestment rate, and from there I can very easily calculate, back calculation can be done, right? Okay. Let's calculate then. I'll increase the font size for you all. I know that the change in revenue will be how much? 5520 minus 4800, which will be around 720 CR. I can calculate my expected reinvestment because I know my sales to capital ratio is given to me as sales to capital ratio is 2.40. So capital to sales will be how much? 1 upon 2.40, right? Just the opposite of it, which will be approx how much? 1 divided by 2.40, 41.66, right? I know that the reinvestment is the retention ratio is 1. That is, we are reinvesting total we are reinvesting. I already have invested capital at the beginning of year as 3000 CR. Correct? And the change will be how much? 720 CR. There will be a change of 720. That my revenue will increase by 720. So I will reinvest all of it. Right? Correct? Makes sense that I will reinvest whole of my this thing. The all of my revenue will be reinvested. Right? Okay. So 720 I am reinvesting divided by 240. This is how much I am going to reinvest, that which will be equal to 300 CR, which is already given to us, 3000 CR. 720 divided by 2.50, which is equals to 300. This is the reinvestment rate. Okay. So reinvestment rate will be 300 you are reinvesting, 300 CR you are reinvesting divided by 660. What is 660 for us? 660 is your no pat. No pat is given to you. So how much are you reinvesting in the company? 300 out of 660. 300 out of 360, that is 45.45% you are reinvesting. So reinvestment rate is 45.45. So your return on capital will be 660 divided by 3000, which is 22%. So expected growth rate will be reinvestment rate or retention rate into your ROE. So that is how you are going to calculate your G, growth. That is how growth will be calculated. Very important, very, very important question. 9.99%, which is approx 10%. So A is the correct answer. What I did was, I had my sales to capital ratio with me, which was 2.40. I just wanted to know how much will I have capital to sales. 1 upon 1.240, right? I will have my revenue changed from 5520. From 4800, the revenue will change to 5520. So there will be an increase of 720, which will be reinvested 100%, because it is given that retention ratio is 1. Firm reinvestment, all reinvestment requirement. Everything is reinvested. So this 720 will also be reinvested. So that is why 720 divided by 240. So the expected reinvestment rate is 300. Right? Since I don't know my investment rate, so 1 divided by 240 is my capital by your sales. And sales are now, capital by sales is equals to 1 upon 2.40. But sales are now how much? Capital will be equal to, sales is 720 divided by 2.40. Correct? Correct. Cross multiplication is applied, nothing else. Just cross multiplication is applied. Just cross multiplication is applied. Sales went up here. Sales went up here. That's it. So the capital is, the reinvested capital is 300 CR. What is the reinvestment rate then? 300 divided by NOPAT. And what is your return on capital? 660, that is your NOPAT, divided by your total invested capital, 22%. So 1 into 2 will give you a rate, expected growth rate. Making sense, right? Check. Next question. Any doubt till here? Anybody? Any doubt till here? If you have any doubt, please let me know. Any doubt? Anybody? Right? Check. Next question. Any doubts still here? Okay, next question. Question number 3. A distressed manufacturing company, important question. This is for distressed industry. We did our question for, we did our good amount, we spent a good amount of time on distressed manufacturing companies. So a distressed manufacturing company is evaluated in 2025. The analysis says that the probability of surviving is only 0.62, that is 62% only. Free cash flows are given to me. Terminal growth rate is also given to me. WACC is given to me, and liquidated sales value is also given to me. So this is my terminal value, right? This terminal value will also be discounted. Present value will have to be taken care of. What is the value of the firm right now? Simple, very simple. What I do is, I find out my terminal value. Let me make certain changes for you all. Okay, I calculate my terminal value, that is FCFF 4 into 1 plus G divided by R minus G, which will be 68 into 1 plus G, 68 into 1 plus G, the terminal growth rate is 3.5%. 3 point, which will be 68 into 1 plus 0.04, which will come out to 70.72. Sorry, it is 3.5%. I am stuck to 0.4 since we have been doing it for so many questions. So 1.035 into 68, which will come to 70.38. So 70.38 divided by R minus G, which is 0.077, which will come, terminal value is 914.02. So the decimal discounted terminal value will be, discount rate will be used here. So the total DCF will be 171 plus this much, which will come to 770, So distressed liquid sale value, I'm sorry, I told this wrong to you before. This is not the terminal value. This is the sales value that you have right now. That's it. That's the whole use of it. Not much needed here. 210 will be your distressed liquid rate, which is not much used here. So yes, done. Simple question for discounted two-stage model that we followed. Same, exactly same. I have my terminal growth rate, so I can find out my terminal value, which will be 68 into 1 plus 0.035 divided by WAC. WAC is how much? 0.112 minus 0.035. You calculate the present value for this plus the present value for all 4 years. You will have your value of the firm. You have your value of the firm. Simple. A bank reports the following financial details. ROE is 13.5%. Okay. Expected ROE is 15.2. Dividend payout ratio is 38. So what is your retention ratio? 1 minus 0.38, 0.62. Retention ratio is 0.62. Your expected ROE is 15.2. The bank is expected to increase its buyback program. Such that the effective payout, including the buyback, important, very important, that including the buyout, we want it to be 46%. The bank's market analyst expects the shift ROE should be incorporated in the EPS growth rate. Makes sense, yes. Use the modified fundamental growth formula. Okay, this is the direct formula question. We can directly jump to the formula, which is nothing but, let me change the font. Yeah, very simple, direct formula, which is, so retention ratio is 1 minus effective payout, and expected growth is constant ROE. Always remember that constant ROE is to be taken. So retention ratio into ROE, which will be expected growth, will be retention ratio into ROE of t plus 1 plus ROE of t plus 1 minus ROE of t divided by ROE of t. Basically, what is the change in ROE divided by ROE t? Current ratio. Current. So it will be, the retention ratio is 54, 1 minus 46, which will be 54%, because the buyback, we want our dividend to be this and not this. We want it to be 46. That is why the retention is 54%. So change in ROE formula will be 54 into 0.152. That is the rate that we want. That is the rate we want, 15.2%. Expected rate, right? Plus 15.2 minus previous rate divided by previous rate, and you will get your formula. Direct formula question. What we did was, growth is retention ratio into ROE. Since there is a change in ROE, we want stable ROE, which will be ROE for the coming years plus ROE for the coming year minus ROE for the current year divided by ROE of the current year. That is the growth in ROE, right? So that is how you calculate it, which will be 20.78. C is the correct answer. Any doubt, anybody till here? Any doubt, anybody? It's a simple direct question from the formula. Any doubt, anybody? Please do let me know. Okay, next question. A company Okay, so I think I will have to adjust the screen. Let's take the options to the next page. Right, and let's increase the size for this hair. More visible now, right? A company is undergoing asset based valuation for acquisition, that is merger. The latest audited balance sheet is this much. Book value is given to us. Valuation adjustments are given. Land and building upward, positive change. Plant and machinery fair value is 105, so positive change. Inventory includes obsolete stock worth 7 crore, realizable at only 40% of cost. Inventory 7 crores is reliable only 40%, so minus, negative impact, right? Then expected credit loss for receivables is 6%. So this 6% is your negative impact that you have to take. Ignore the book provisions. Okay, great. We can ignore it. Use ECL. We can use ECL. Okay. Acquisition requires a recognition of contingent liability of 8 crores at present value. Okay. So this 8 crores at present value. What is the present value? Okay, we can take 8 crores as negative impact. Term loan settlement will include 2% prepayment penalty. Term loan, so negative impact again. Cash and bank has no adjustment. Of course, it will have no adjustment. So question says, what is the asset based valuation, equity value of the company? Okay, simple. What I am going to do is I'll find my revalued adjusted assets. My land and building will go up by 15%, so it will be 138. Okay, so let me help you by changing the font of my this thing. Right, makes more sense now. Okay, land and building is 120 and it will increase by 15%, so the new value will be 138. Plant and machinery fair value is 105. Inventory obsolete is for 7. Realizable only 40%. So 7 ka 40% is how much? 2.8. I get this. Non-obsolete is 48. So total inventory will be 48 plus 2.8, 50.8 total inventory. Right now I have. Trade receivables 48 is the gross block and 6% ECL is to be made, that is 2.88. So net realizable will be 48 minus 2.88, that is 45.12 that I have with me. Cash in bank has no impact. So the total fair value of my assets will be 138 plus 105 plus 50.8 plus 45.12 plus 6 which will come to 344.92 CRs. Adjusted liability will be how much? I have my trade payables as 42, term loan as 60 minus, there will be just a liability. So 42 and prepayment liability of 2%. So settlement value will be 61.2, right? And contingent liability of 8. So total liability I have right now is 112.2. Okay. So the equity will be how much? I have my assets. I have my liability. Can't I calculate my equity? I know capital plus liability will be equal to asset. From here, this equation, I can calculate my capital. That will be the equity value, right? So it will be total assets minus total liabilities, which will be 233.72. 233.72. C is the correct answer. C is the correct answer. Now tell me, anybody, any doubt till here? Anybody, any doubt till here? If you have any sort of doubt, you let me know and we will move forward accordingly. So this was the end of module C, right? So this was the end of module C. From my side, we have done all necessary questions that can be asked in exams from module C. Let's move to module A now. Since it is comparatively easier, the numericals there are in lesser number, let's at least complete our module A now. So we will be done with module A, we'll be done with module C, and we can see if we can take some questions from module B as well. Okay. Any doubt in module B, you let me know. Any doubt? Anybody? Okay. For module A, let's start with unit 6. That is the first unit with numericals. A bank-owned fintech sells two analytical products. Product A and product B both have mixed cost structure. Total fixed cost overhead is this, including 1 CR for non-cash depreciation and 3 for cash fixed cost. Supervisory tax upgrade is necessary if the sales cross 18,000. With semi fixed cost will be included if the sales cross 18,000. The firm target a post-tax profit of this. This is the targeted profit for us. And our tax rate is given to us as 25% and requires break-even point in unit. Important. Under the expectation that the sales will exceed 13,000 threshold. We know that it will increase. So yes, this will be taken up. Use WACC per unit. Okay. Even if WACC was not given, I would have taken WACC only. What is the break-even quantity? Total units. Very, very important questions and very easy question. Since I know, let's follow one simple trail. That is sales minus your variable cost will give you your contribution minus your fixed cost if the profit is zero. If the profit is zero, no profit, no loss, this is my break-even point. This is my break-even point, right? So what I'm doing is, this is the line, right? I am here. I cover all my cost. I get my contribution. I cover all my fixed cost. Then my break-even is achieved. My break-even is achieved, right? This is what we are trying to do. Today, I am at 0 point. I calculate my contribution, that is sales minus your variable cost. I subtract my fixed cost also from it, then I get my break-even point. That at this point, there is no profit and no loss. So let's calculate our break-even quantity for 25-26 for product A and product B. For product A, my contribution will be 5,500 minus 3,100. That will be a contribution for product A, and for product B, 7,200 minus 4,400. 2,400 and 2,800 respectively. Now I can calculate my WACC, which will be the sales mix says that the expected sales mix is 60% and 40%. That is 60% is the weight for product A and 40% is the weight for product B. Weights are given to me. I can very easily, from the contribution that I have calculated, I can calculate my WACC, that is 2,560 per unit. Correct. Now you compute the fixed cost relevant for break even. For my fixed cost, I have 4.20 as my fixed cost plus 40 lakhs that I have to take, since we know 18,000 will be crossed. 18,000 will be crossed. So the fixed cost will be 4.20 plus 0.4, which is 4.60 CR. Break even requires zero profit, so the target, not the targeted profit. I really, this line, the targeted profit line, where is the line? That my targeted profit. This is of no use to me, honestly. For break even, the profit has to be zero. This is what I said, right? Thus, we do not adjust for tax here. That is why tax is not adjusted. Okay. Fixed cost is 4.60 CR. Break-even units will be fixed cost divided by your WACC. This is your break-even point. This is your break-even point. See, my break-even point will be when my fixed cost is covered, and thus the formula comes into picture, which is fixed cost divided by your sales. Units sales. Since sales is not taken up, WACC is taken up, so fixed cost upon WACC. Fixed cost upon WACC. So that is it will be 17,969 units. 17,969 units. C is the correct answer. C is the correct answer. Anybody, any doubt here? Do let me know. Anybody, any doubt here? Let me go away from the screen for a second so that you can see the formula. Now tell me, anybody, any sort of doubt here? It was a good question, simple logic and very good, easily calculated. Any doubt? Okay. Moving ahead then. Next question. A bank's investment decision evaluate a 4-year strategic plan launched on 1st April. Initial investment is this much. Additional capital infusion will be 2.8 CR. At the beginning of year 3, depreciation is given, corporate tax is given, annual flows are cash inflows are given to us. Other information that there will be an impairment loss, which will reduce the book value only, not the cash flow. So this is not of any use to us. Salvage value use of us. What is the ROI, return on investment? So what is my ROI as of now? Again, very simple logical question. What I do is I can calculate my debt, which will be on original cost, which is my initial investment is 12.5 CR, right? So 12.5 पे 15% हम SLM लगाएंगे, so it will be 1.87 CR per year. I have 4-year model with me. So for first year, my profit before tax is given to me as before depreciation and taxes. 4.20. So 4.20 minus your debt, it will be then profit before tax only. Because I have profit before tax and depreciation is given to me, I want to calculate my PBT. I can subtract my taxes and my PAT. I will get my PAT for every year. This can be done, right? For 4th year, operating profit is 5.4 minus your debt, add the salvage value to it. So the total PBT will be 5.775. Calculate the taxes and you will get your PAT, which is 4.33125. Average PAT can be taken out. I have PAT 1, 2, 3, 4 divided by 4. That is my average PAT. Then I calculate my average investment. Now opening investment was 12.5 less the depreciation over 4 years, which will be 7.5. You add the impairment because only book value was changed, no actual inflow was changed. So I add back the loss which was previously subtracted. So I add impairment, I add my investment, and average effect will be half since it is included in 3rd year onward, right? 4-year project and 3rd year onward the capital was improved. So the impact will be half of it. For total 4 and beginning of 3rd year capital was introduced. So 2-year impact should be taken. So average investment will be 12.5 plus 12.5 less the depreciation plus 11.125 plus 12.05 plus 11.175 divided by 4. That is the average, right? So the ROI will be your average PAT divided by your average investment, which will come back to 22.49. which will come to 22.49. Now tell me, any doubt anybody here? Any doubt anybody here? Even if you have little bit of doubt, do let me know. Any concept that you want me to cover, I'll cover it. Don't worry about that. Since it is a good question and can be asked in exam, a very simple question. Module A doesn't have a lot of numericals. Any doubt? Okay. Next question. A company reports the following figures. Net sales is given to me, COGS is given to me, EBITDA is given to me, EBIT is given to me, net profit after tax is given to me. Important for me. I have been given current assets, inventory, total current liabilities. Okay. Shareholder equity is given to me, total debt is given to me, and total assets are also given to me. Okay. Average accounts receivable, average accounts payable. Compute net profit margin and current ratio. Very important. For exam, current ratio is what? C upon CL. Right? Net profit margin also we can calculate. That is your net profit divided by your sales. So let's calculate. It's a very simple question. Very simple question. Your net profit will be net profit after tax divided by net sales into 100. So net profit after tax is how much? 118 divided by your net sales. Are net sales given to me? Yes, 1250 into 100. So my net profit margin is 9.44. 9.2 options have 9.24. Let's get rid of the other two options. Then I can calculate my total current assets divided by total current liability. Will be total current assets is given to me as total current liability is 310. Total current assets is 520. So 520 divided by 310, 1.67. So A is the correct answer. So 9.44 is 1.677 is to 1. So A is the correct answer. A is the correct answer. So simple, such a lengthy question, but such simple calculations, right? Applying logics. Again, throughout the module, I told you, the more logics you apply, it will be easier for you. Lesser the calculations, easier calculations, right? More the chances of you clearing the exam. Moving ahead, if you have no doubts, then I can move ahead to the next question. Compute debt to equity ratio and inventory turnover ratio. Debt to equity is what? Debt upon equity. Debt, do I have total debt? Given to me. Do I have shareholder equity? Given to me. Can I calculate debt to equity? Yes. So debt to equity is total debt divided by equity, 420 divided by 680. Right. Next is total inventory turnover ratio. Such a simple question. Inventory turnover ratio is your COGS divided by your average inventory, which is, do I have my COGS? Yes. Do I have my average inventory with me? Inventory is 140. And average accounts receivables are also given as 125. 140. 140 is also given to me, and 875 is also given to me. So 8.25. So option number D is the correct answer. All you have to do is remember the formulas for module A. Remember the formulas. I'm sure when you did module A also, logics were given to you. That is why simpler to remember the formulas. Next, Next question for us is with module B. Since I told you not much questions in module A, let's start with module B, unit 8. A company for financial year 25-26 reports the following data. Sales is 320 CR. Variable cost ratio is 62%. Okay. Fixed operating cost is 48. Existing debt, corporate tax, proposed additional debt at this rate to be taken in the beginning of 25-26. Additional borrowing will increase the fixed operating cost by 4.5. So operating plus this due to compliance and processing overhead. What is the degree of financial leverage at the new EBIT level after raising additional debt? Important. You need to read the question. So first I find out my contribution. See, sales minus your variable cost is your contribution. Can I write that contribution is equals to 1 minus VCR? Can I write that into sales? Of course. Into sales? Of course. Contribution can be written as sales minus into 1 minus VCR, that is sales into your fixed wala portion, which will be your post. Basically I want to understand what are my post variable cost sales, right? So sales into post VCR, 1 minus taxes, you got post debt, right? So post my variable cost, how much my sales are left, that is my contribution. Or you can do is 320, since I do not have my amount of VCR, 62% of what, that is why 1 minus VCR, right? So sales into 1 minus VCR, so I am calculating post variable cost sales, right? This is what I'm trying. If sales are 100%, 320, I minus 62%, that is 100 minus 62, 38%. 38% of sales will be how much? At 100% sales are 320, at 38% sales will be 320 into 38%, that is 320 into 1 minus VCR, that is 121.6 CR. That is your contribution. That is your contribution, right? EBIT before additional debt we can calculate. Yes, contribution minus your fixed cost. Contribution minus fixed cost will give you profit or EBIT before taxes and interest, right? Which is 73.6. Revised fixed operational cost will be 48 plus 4.5, 48 plus 4.5, which will be 52.5. So new EBIT will be how much? 121 minus 52, which will be 69.1. Total interest will be existing interest, that is 150 into, existing is 150 into 9.6 plus 50 into 10.2. 150 into 9.6 plus 50 into 10.2, which is 19.5. So your leverage will be, your DFL will be, degree of financial leverage will be EBIT upon EBT. EBIT upon EBT is your leverage, financial leverage, degree of financial leverage. So EBIT 69.1 new EBIT divided by new EBIT minus your new interest, that is EBT, which will come to 1.39, which will come to 1.39. A is the correct answer. So A is the correct answer. Making sense, right? Making sense, right? Achha, I'll go away from the screen once again so that the formula is visible to you all. So that the formula is visible to all. How did I calculate this? Okay. Moving ahead, next question we have is, a company reports the following data. Sales is this much, variable cost is this much. I can calculate contribution from this. Fixed Cost is given. I can calculate EBIT, contribution minus your profit. See, sales minus VC is contribution, minus your fixed cost is your profit or your EBIT, right? Capital structure is given to me. Additional information says the company earns operating income of 6 lakhs. One time non-cash expense of 8 lakh is included in operating cost. So you add it back. Okay. Ignore it while calculating EBIT because in EBIT it is not there. Interest on long term is paid full year before repayment. What is the degree of financial leverage? The question says degree of financial leverage at EBIT level. Very simple. I calculate my contribution. That is 62% of 480. 480 is your sales, right? So 480 ka 62% is how much? 297. So contribution will be sales minus variable cost, which will be 182.4. Sales minus variable cost will give you contribution. And I told you in such questions you can also do sales into 1 minus VCR will be your contribution. So you could have done 1 minus VCR is 0.62 into sales, which is 480. It would have been 182.4. Directly you could have taken it out. Right? Now for adjusted fixed cost, we know that the given fixed cost is 84 less the non-cash expense because we don't want that. This is a non-cash expense for 84 and a one-time non-cash expense for 8 was taken. This was not in terms of cash, that is why हम fixed cost में से हटा रहे हैं इसको. So the adjusted fixed cost is 76. Actual fixed cost in cash, right? For EBIT calculation, I have my contribution minus your adjusted fixed cost plus other operating income. I have my other operating income, which is other operating income is 6 lakh rupees, right? So EBIT will be earnings before interest and taxes. All earnings I have to take. Correct? So I have 182.4 minus your adjusted fixed cost, EBIT, plus your other incomes, which is 112.4. For your interest calculations, debenture interest is 150 into 9.6 and 70 lakhs into 12%. Right? So processing, and there will be a processing fees of 1.2%, which is 0.84 lakh rupees. So total financial charges 23.67. So what is my DFL? My DFL will be 112 divided by EBT. We are in earnings after taxes, earning before taxes, sorry, which will be 112 minus 23, 112.4 minus 23.64, which will come to 88.76. So 1.266 is your answer. Any doubt, anybody here? Please let me know if you have any sort of doubt. Right? I'll go away from the screen just in case you want to see the formula, the calculations. I have no problem with that. Right? I'll show you the calculations again. So yes, it was a pretty easy question. Again, I would like to add here module B, module A, simpler numericals. Module C, good numericals. And if you will get numericals in your exam, majorly it should be from module C. Module A, module B, very easy numericals. You just have to get your concepts clear and mathematical calculations are very easy. Okay. For module C, there were a lot of formulas. That is why difficult. A company reports the financial data. Based on this, compute debt to asset ratio, debt to equity ratio, equity multiplier, debt to EBITDA and interest coverage ratio. So simple. I calculate my debt to asset ratio. First of all, my debt to assets, debt to total assets is given to me, total equity is given to me. So I know equity plus debt equals to total assets. So debt will be how much? 9600 divided by 9600 minus 2400, which will be 7200, right? Which will be 7200 divided by your assets divided by your assets, and your assets are 9600. 7200 divided by 9600. Simple. See, from the balance sheet, capital plus liability is equals to asset, right? So from here, I can calculate my debt. Debt to equity, that is 7200 divided by 2400. 7200 divided by 2400. For equity multiplier, simple, total assets divided by total equity. For total assets, 9600 divided by total equity, that is 2400. Debt to EBITDA, that is 7200 divided by 1350. 7200 divided by 1350. And for your interest coverage ratio, interest divided by total interest. Wait for a second. Since this is not working, okay, which will be 1080 total interest divided by 270. Interest, interest coverage ratio will be your in denominator. Your interest will be in denominator, right? And you have your this thing, EBIT in the numerator. EBIT divided by your EBIT 1080 divided by your interest. This is how many times you can cover your interest from your EBIT. So which will come to 4. So this is the correct answer. Option number A is the correct answer. Now tell me, anybody, any doubt till here? Anybody, any doubt? Easy question, right? Next. So yes, all major questions are covered like that. I will do this last question. I'll take up the last question here, then I'll end the session. Manufacturing firm reports the following. Sales is given, variable cost is given. I can calculate my contribution, sales minus variable cost. Fixed operating cost is given. I can calculate my profit or EBIT. Quantity sold is 52,000. So it will be contribution into quantity minus your fixed cost, because it is a total cost. I'll get my EBIT. Okay. The firm is evaluating the impact of proposed automation where fixed cost will increase by this much, but variable cost will reduce by this much. Selling price remains unchanged. Degree of operating leverage is to be taken if sales increase by 5%. Important. Question has changed. Sales are increasing by 5% after adopting the automation plan. Good question. So revised variable cost will be 315 minus 7%, which will be 292.95. When your new fixed cost will be 42 plus 840, 42 plus 840, which is 40. Contribution per unit will be, selling price remains same. So 540 minus your new cost, which will be 247.05. Current EBIT before the 5% increases your quantity into contribution minus fixed cost. This we have already done. This we have already taken into account, right? So the current EBIT is your 52,000 into your contribution, current contribution, minus your fixed cost, total fixed cost, which is 7806. So degree of leverage will be contribution, that is since I don't know my contribution, I can always write it as SP minus VC, that is selling price minus variable cost into quantity, divided by SP minus variable cost into your quantity minus fixed cost. That will give you your EBIT, right? Which will come to approx 1.645. Now, if there is a change in EBIT, it will be change in EBIT will be change in degree of leverage has one more formula, right? Change in EBIT divided by change in sales. So, which is 1.64 divided by your new DCL was given and change in EBIT is also given. So, change in sales will be taken into account of 5%, which is 8.255. Right? So, you can have your answer as B. B is your correct answer. So, yes, you can, I can find my degree of operating leverage and what percentage. Both the things can be done. So, yes, easy question. This also was easy, but if you get certain question, you need to have practiced it, only then you will be able to solve it. Right? So, I'll end the session out here and I'll meet you again in the next session. I hope you do your exam wonderfully tomorrow and you are going to achieve, the sky is the limit. I'm telling you that. And always remember, you are not a sum of your failures, but a product of your efforts. So the more efforts you put in, the more results you'll get. All the best for the exam and I'll meet you for the next sessions. Till then, take care. Bye bye. This is Radhika Dua signing off.